Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Lots to talk about. Tariffs, of course, top of mind, top of conversation. Once again, Indonesia this time. Ray of hope, question mark. I'm Prashant. With me, my colleagues Nigel and Rima is with us today. Guys, good morning.
Hi, but still waiting the India-US trade deal, right? I mean, at least for Indonesia, it's come down, the tariff rate to 19% from 32%. But India remains a question mark.
Well, that's right. And it's not a Wednesday, right? We're getting used to Trump saying big, beautiful Wednesday morning. So spoke about coal last night as well. It's not just coal, big and beautiful as well.
So it's his right attitude to start your day, right? I mean, big and beautiful. Why not? Well, let's just quickly take a look at what you need to know as you start another trading session. So let's take it from the top. So President Trump essentially said that Indonesia will pay a 19% tariff after securing a trade deal. So 19 on Indonesian goods, 0 on US goods. But this is the thing. The letter which was sent to Indonesia earlier had 32% as the tariff rate. And that's the point here. So that 32% in a few days of negotiation, back and forth, etc., has come down to 19%. And that is the reason why I'm saying a positive sign, perhaps, for those who got letters and are negotiating. Important point is those who got letters and are negotiating. So two countries in particular, there's Philippines and there is Thailand as well, if you can move this along. And of course, I mean, it kind of also confirms the market's view that higher tariffs will be revised lower. Eventually, higher tariffs will be revised lower. The Indonesian deal also shows that eventual US tariffs will come off but still remain high, around the 20-odd% mark. So, of course, I mean, the market expectation is that end-state tariffs could be between 10-15%, but that's moving up. Will it finally land up at around 20%? We'll have to see. It'll be a big jump because, I mean, when Trump took office, I think that number was about 3%, 4% or so. Of course, President Trump also hinted that there will be a couple of more deals announced soon. He hinted that India is working along the same line as Indonesia. But of course, I mean, we didn't get a letter, so we are kind of sort of starting from scratch. We don't know where that process is at this point in time. If the Indonesian deal, as President Trump himself said, is any indication, I mean, we'll see how this one goes. But markets, of course, are not holding their breath. I mean, I've said this before as well. It's not as if tariff news flow is really moving markets in a big way. 30% on the EU over the weekend did not move the euro or the dollar in a meaningful way. So I think not very much else will. That is as big as it gets in terms of trading partners and a big tariff being announced there. US equities last night, I mean, they sold off a little bit. S&P was down 0.4. The Russell was down about 1.9% as well. But, again, a little bit up, a little bit down, but broadly, I think it is the markets remain pretty constructive. Nvidia, of course, continued to drive the Nasdaq outperformance. The Nasdaq actually ended higher, unlike what the S&P or the Russell did. The 10-year was up about 5 basis points. We're back to about 4.5%. The dollar index is bouncing around about 98.5 odd on the broader dollar. So those are sort of roughly levels we are looking at. Macro markets, I mean, largely remain. You get these bouts of uncertainty and huge moves, and then the market cools off and does nothing for long periods of time. That's essentially what we've seen in 2025. I'll just circle and tie in the levels then. Yesterday, of course, the market. So Friday was a big corrective day. Nifty lost 200 points. Monday, of course, the market came off a little bit as well. Yesterday, we got a bounce. And we'll need to see if the correction, it's a short correction, it is complete or not. And if it is complete, then the low of 25,001 should not be broken, and it should hold. And on the upside, I mean, the 61.8% retracement of this very short fall is 25,400, a very immediate kind of level on the upside, which we'll need to sort of climb up above. For the Nifty Bank, similarly, the support is 56,594 on the downside. Bank Nifty, of course, also ended high yesterday. 57,628 is that same upside level for the Nifty Bank, which we need to climb up above for the market to look a little more constructive. So in that sense, an interesting kind of day. GIFT Nifty is indicating 80-odd point, lower start once again. Rima.
So pretty much giving up yesterday's gains. So yesterday, the Indian market snapped a 4-day losing streak to end higher by about 110 points. The mid and the small cap indices outperformed, gaining for the second day in a row, up 1% on that. But let's just quickly take a look at the top cues that are shaping trade today. First, on the flows, the DIIs and FIs net buyers. The DIIs buying close to about 1,500 crore in the cash market. FI buying muted at 120 crore. On the global radar will be key prints from the US, the PPI index. We had the CPI print yesterday. Now the producer price index will be tracked, the industrial production and the Federal Reserve beige book. On the earnings front in the United States, big banks will continue to report their numbers. Overnight, we had numbers from JP Morgan, Citi, Wells Fargo. Today, it's going to be Goldman Sachs, Bank of America and Morgan Stanley. Back home, earnings reaction, and we'll discuss them in top 10 in greater detail, but HDFC Life, ICICI Lombard, HDB Financial Services, Network 18 just dialed. And amongst the big ones reporting numbers today, in the Nifty pack, only one. Tech Mahindra. But outside of that, LTTS, that's L&T Technology Services, Angel One, ITC Hotels, Orient Hotels, and Ixigo. And Glenmark, after that big deal, will be holding its investor day today. And finally, on the India-US trade deal front, a fresh round of negotiations is currently underway in Washington with the Commerce Ministry team on ground. And Chief Negotiator Rajesh Agarwal is set to join the talks today, as both sides are hoping to, finally get that deal going. So those are some of the big things you need to watch today. But Nigel, what are you looking at?
Well, in yesterday's trading session, though the Nifty has been consolidating for the last few days, the good part is the small cap index put on another percent. And for this week itself, if you look at the small cap index, well, it's gone up 1% each on both the two trading sessions, and it's at a 6-month high. So that's pretty good news. Good close is what we saw on the small cap index. Well, what about, the other positive for me yesterday was that after a while, we made a higher high. So all these trading sessions, we were making lower highs. And yesterday, in fact, it was a little bit higher. So that's good news, in fact. You'd like to make a higher high. Today, I know the Nifty is going to be starting off in the red, but maybe this is the level that you should be looking at. We like to make a higher high yet again. So we'll keep an eye out on that front. What about the FIs? Well, they added some mild shorts. The clients, though, they are piling on the longs. And if you just take a look at the chart, you'll see that the client positioning, well, it's moving towards that 1 lakh contracts on the long side. While on the short side, the FI short positions, well, they're holding at around 1.21 lakh contracts. As I've been saying in the past, this is the combination normally that you like. With the FIs, having some shorts in the system gives you a bit of a cushion, provided things don't go horribly wrong. And in percentage terms, the FI short positions are at around that 81% or thereabouts. Well, the options data should come up for you on the screen. And, if there was some put writing yesterday. So we saw a bounce from the lows. So today it will be challenging to see whether or not these puts are unbound, because yesterday there was some writing that we saw both at the 25,200 put, 25,100 put as well, which brings us to the levels that we're looking at. Well, in terms of a support, the 24,950 and 25,000 mark is important. Here's where the 50 DMA comes in at. Here's where, in fact, you have the recent low as well. And it's almost a 50% retracement of that entire move that we saw, from the lows to the highs and then the pullback. So this level, this range is very important. On the upside, as I said, yesterday's high will be 25,245 or thereabouts. But the 20 DMA, that becomes the line in the sand. The Nifty Bank, that'll have to lead the way. And that's actually been doing that. And it continues to hold above the 20 as well as the 50 DMA. So that's why, in fact, this one is the one that will have to hold its ground. Till these levels are protected, you'll have to say that the Nifty Bank is in a good space. Stocks that I'm looking at, Biocon, the last few years, the stock actually has been a relative underperformer. But they have got an FDA nod for the biosimilar, that's insulin aspart. And, that has a very, very large market out there. So we'll have to keep an eye out on this one. There was some bit of pre-buying that we saw yesterday. So Biocon is one stock. And the other one I'm looking at, is Bombay Dyeing. Yesterday, we had massive delivery-based buying on this particular name. And it conquered the 20 DMA on a closing basis as well. So cash market stock, we'll keep an eye out on this one. Much higher delivery-based buying is what we saw on this name.
On our radar is Bombay Dyeing. Thank you for that. Let's get to the equity calls then. Venugopal Gare of Bernstein says, while the strain is evident and the government appears to be relatively quieter than they were in NDA 1 and NDA 2, a supportive base, improving liquidity and limited risk from global sources should continue to support a 6.5% range for the economy this year. He says they do not see India in a phase of collapse that we had in the middle of last year, protecting downside risk. He expects some more returns for the Nifty, and their year-end target stays at 26,500, which is another 5% return in H2. From a sector perspective, he says they shift some weights from utilities to staples, moving it into a tactical overweight for a short period. Utilities moves to an equal weight, and they stay overweight on financials, telecom, small discretionary.
Ed Yardeni is with us. He's president at Yardeni Research. Ed, good morning. Great to have you back on the show and on the program as well. This Indonesian deal, 19%, the letter said 32%. How should others who are kind of sort of, waiting to negotiate read this? As I was saying earlier, I don't know if it's the right way to look at it, that maybe, there is room for negotiation, but eventual tariff rates are looking like they're going to be closer to 20%, so very high, still very high.
Yeah, still very high, and I think the president has a number of objectives when it comes to tariffs. One of them is to raise revenues, and he's clearly very pleased with what he's seen so far, because at an annual rate, over the past 3 months, we've seen customs duties up at an annual rate of $300 billion. Plus, a little bit higher than that, actually. So I guess he's figuring if he can get that with 10%, then with 20%, he could get $600 billion. And if the rest of the world is okay with it, then that's what it'll be. But at the end of the day, it's not Indonesia that's going to pay that. It's going to be American consumers. It's going to be American companies. Some Indonesian companies may give a break to their American customers and eat some of that tariff, but for the most part, it's a tax on Americans.
And the new tariff rates are much higher than the base case that most investors and economists were expecting. But despite all that, Ed, markets have been very well behaved. It's been a very muted reaction in the financial markets. So what do you make of that? And what are your clients saying, thinking, acting now?
Well, I think my clients are kind of reflecting what's going on in the market. They're a little bit more relaxed than they were back in April about what's going on with tariffs and its impact on the market. I think one of the reasons the market is doing so well is because people have come around to kind of a view I've had for really the past 3 years, and that is don't bet against, don't underestimate the resilience, the strength of the U.S. economy. It put up with a dramatic increase in the federal funds rate, a dramatic monetary tightening, and yet we did not have a recession. And here, so far, knock on wood, so far so good. We've had a situation where the tariff turmoil that we've had so far doesn't look like it's really causing a recession. So I think there's just more confidence that the economy is resilient. Not only that, but earnings were very good in the first quarter, and now there's expectations that the second quarter could also see earnings beat expectations because they've been knocked down so low. It's not going to be that hard to beat them.
Hi, Ed. Good morning. Good to see you. When, just looking at a couple of estimates, and earnings season in the United States is expected to deliver 4.3% growth, which will actually be the lowest growth we've seen in multiple quarters. And yesterday, the earnings that we got in from some of those banking names, Wells Fargo, JP Morgan, BlackRock, some of them were digested as a bit of a miss. So how do you see, earnings pick up from here on? Do you believe that that earnings will actually be better than what the street was working with? Point number one. And point number two, just wanted your comment on the inflation print that we got in yesterday. I think you're in the camp that believes no more rate cuts, right, coming from the Fed in this year. So just want to comment on that as well.
Well, sure, absolutely. So the bank earnings look just fine to me. I think the reason the bank stocks didn't rally on them is because they already rallied. I think there was a lot of expectations that the banks would do just fine. The bank stocks have already discounted a lot of the good news. And the number I'm looking at is like 3.5%. Maybe you're right. Maybe there's another number out there, 4.5% for year over year as the current consensus of analysts. But they always tend to be too pessimistic, almost always tend to be too pessimistic. And I think it's going to be double that. I think it's going to be 7% on a year-over-year basis. So I think we're going to beat that. And that's exactly what we did in the first quarter. Now, with regards to the Fed. The CPI today came in warm, not hot. Came a little bit stronger than anticipated, but we're looking at a CPI inflation rate on a core basis, excluding food and energy, of close to 3%. I think what the Trump tariffs have done is they've kind of stalled out. They've forced the decline in the CPI inflation rate, which was heading down to 2%. Looks like it's stuck now around 3%, which is not what the Fed wants to see. The Fed wants to see that inflation's continue to moderate to 2%. If it's stuck now at 3%, all the more reason why the Fed will not be in any rush to satisfy Donald Trump. I mean, there's no way they're going to give him a 1% Fed funds rate when it's 4.3% now. And there might be no way that even if he gets rid of Powell, that the remaining consensus on the FOMC, the Federal Open Market Committee, will in fact, again, lower rates. So I think rates are where they should be.
Yeah, no, absolutely. Ed, two very quick points, if you can respond. One, of course, is I think there were some comments from the Treasury Secretary last evening, but where he said that, well, I think he kind of sort of pushed back on the idea of this shadow Fed. He said it'll create confusion. So that is one, if you want to sort of weigh in. Second, of course, is NVIDIA being allowed to sell these high-end chips to China once again. And NVIDIA was the reason NASDAQ was higher last night.
Yep.
So does that show a bit of thaw in that relationship? Or not really?
Well, I think what it shows is that everything is negotiable and everything can be renegotiated a few times. So the head of NVIDIA went to see the president and convinced him that the chips that NVIDIA wants to sell China are not state of the art, and at any rate that the Chinese are going to develop their own chips if we don't sell them our chips. So the president understood the logic of that and agreed to it. So, yeah, I think it shows some indication that we're willing to be flexible on some of the issues with China. But to a large extent, it was the president responding to an American company saying, hey, look, we're going to be number one no matter what, and we might as well sell to China. What was your other question?
The Fed, the shadow Fed. I think he, yeah. I mean,
it's a crazy idea. It would be extremely messy. I'm not quite sure what Trump's goal is here. I mean, he says his goal is to get rid of Powell, but I'm wondering if his real goal is to pound the dollar, because every day that he beats up on Powell, the dollar goes down. Now, I happen to think the dollar's bottomed here, and that the markets are starting to get a little bit bored with these attacks on Powell. And the markets realize that it's a committee at the Federal Open Market Committee. And so even if Powell is replaced, it doesn't necessarily mean that the Fed is going to give the president what he wants. But I also heard that there's some rumors about the possibility that Treasury Secretary Bessent might also be appointed the head of the chair of the Fed, which would be kind of a strange situation, because that would certainly muck up the credibility of the Fed as being independent. But I mean, my advice to the president is you've accomplished a lot. Go on the campaign trail for the midterm elections and leave the Fed alone. You don't need lower interest rates. The economy is doing just fine. Yeah, save lower interest rates for when we really need them, and do something about the deficit that's really, reduces outlays and increases receipts.
On that subject about Scott Bessent being the Fed chair, I think Bloomberg ran a story after that saying the U.S. president stated that Treasury Secretary Bessent is an option for the post, but not necessarily the top option, because he likes the job that Bessent is currently doing as the Treasury at the moment.
Okay, all right. Well, we'll thank you, Ed, for joining in giving us your view on the markets, economy, as well as on earnings. And guys, by the way, it wasn't a big, beautiful bill. He spoke about coal yesterday. He said it should be called not coal, but clean, beautiful coal. So he changed it around from the big, beautiful to now clean, beautiful for coal itself. Quite interesting. Coal, clean and beautiful.
Well, I think you can rebrand anything, right?
Yeah.
You say it often enough. Well, let's just quickly run you through the interactions which are lined up here over the next 2.5 hours or so. This is what's coming up. 8:35, we'll hear from Karan Thorani, Vilara Capital. We'll discuss, of course, what's happened yesterday. Karnataka capping movie tickets at 200 rupees. 9 o'clock, we'll have Jai Kale Vilara to talk to us about the key trends in the auto space. 9:20, Samir Arora of Helios will join us. He's a market master of the day. 9:30, Bhavesh Shah of Equirus and Rahul Modi of Ambit will be with us to discuss pickup in M&A activity, the key drivers and likely trends. And following that, Praveen Sahai of PL Capital speaking to us at 9:40. Expectation of the consumer sector for the first quarter, that's QSQT. A little later, 9:50. Gopal Balachandran of ICICI Lombard talks to us about the numbers which came through yesterday. And towards the end of the program, Lata in conversation with the management of Bank of Maharashtra on their first quarter earnings.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. We're looking at ICICI Lombard, Just Style, Biocon, Dixon, Zydus Life and Kotak Mahindra Bank. All of them will be reacting to positive news flow. But on the flip side, you'll have HDFC Life, HDB Financial and PVR Inox. They are stocks that could open in the red, while Hathway Cable could see a flattish start. Get into that break, come back, we'll get into further detail on all of these names.
Welcome back. Our research team is now standing by with CNBC-TV18's list of top stocks for the day. First up, let's get a handle on all the insurance numbers that came through. Yash, tell us about HDFC Life.
Well, the numbers for HDFC Life looked good as far as the top line is concerned, but the disappointment has come through because of the margin performance. To be specific about the numbers, the new business premium, that came in exactly a little below what the street was anticipating. So the number that came through was about 7272 crore. The poll that we were working with was about 7489 crore. Total AP was also a little ahead of the street estimates. Retail AP, again, being a little ahead of the street estimates. But as I said, margin was that little disappointment which came through. Margins came in at 25.1% versus the poll that we were working with of about 25.63%. So about 50 basis points miss as far as the margins concerned. The stocks rallied very hard in the last 3 months and 6 months. And hence, that small margin disappointment could actually turn out to be a little bigger than just being small as far as the stock performance today is concerned.
Okay, all right, Yash, thanks a lot for that. Yash, but you want to tell us about another company as well? Lombard as well as a stock that you're tracking?
Well, that's correct. So strong numbers coming in from ICICI Lombard. The net earned premium, that saw a strong growth of 14%. Underwriting profits, underwriting losses rather, they reduced to about 293 crore versus 346 crore on a year-on-year basis. Operating profit, that grew by about 30% at about 654 crore versus 501 crore. And importantly, combined ratio, that saw a slight dip, came in at about 102.9 versus 102.3. So the numbers overall for ICICI Lombard looked very strong. I'm going with green as far as that company is concerned.
Got that. Let's talk about Just Dial. Well, Just Dial was an okay set of numbers. Not very bad, but there was nothing to excite the street. The company on the top line reported a revenue growth of about 3% quarter on quarter. On a year-on-year basis, it was a growth of about 6.2%. And that's broadly been the growth trajectory for the company. If you look at it, so this quarter, year-on-year revenue growth was 6.2%. Before that, it was about 7%. Before that, 8.4%. So in a way, growth has slowed down. But again, Q1 was, it's an okay set of numbers. Margins have come in at 29%, slightly lower than the 29.8% in the prior quarter, and profits have been on the flatter side. Paid campaigns growth stands at 4.3% on a year-on-year basis. Cash in the books continues to remain healthy, nearing 5,500 crore rupees. So all in all, okay set, a bit slow. But even Just Dial's growth has slowed down to single digits and now mid-single digits. But Ekta, what about Biocon?
Well, yes, Biocon is in focus because they've received approval from the US drug regulator for insulin aspart, which is basically a biosimilar insulin, which they have been awaiting approval for a couple of years now. Now, remember that this approval is for the first and only interchangeable biosimilar to Novolog, which exists, which is basically insulin aspart. This particular insulin aspart has been available in Europe and Canada since 2022. But remember that Biocon had faced some issues with regards to the US FDA approval because they received a complete response letter for this particular product approval for deficiencies at their facility in Malaysia, which is where it will be manufactured. This took place in 2022-2023, but eventually the Biocon Malaysia plant was re-inspected in September 2024, and now they've cleared any kind of queries in the CRL, and that's the reason that they've received approval from the US FDA. $100 million is what they could make on a conservative estimate. Depends on the dynamics. It could go up to around $300 million for Biocon as well.
Okay, all right. Ekta, thank you very much for that. PVR Inox is the next one we want to focus on. Vamakshi's got details on this one. Vamакshi, morning.
Good morning, Prashant. Well, not very good news for PVR Inox, and that is because the Karnataka government has, in a draft notification, proposed that movie ticket prices should be capped at 200 rupees. Now, keep in mind that this is only the draft notification, so a time of almost 15 days has been given to the public to submit their feedback on this proposed, proposed regulation. But this could be, if this does go through, it could be a negative for PVR Inox, and that is because almost 40% of PVR Inox screens are located in South India, out of which almost 12.3% are in the state of Karnataka itself. Now keep in mind that earlier on, when PVR Inox did speak to us, they were betting big on the southern market because average occupancy here is above what the consolidated level for the company is. It's at almost around 30%. Now keep in mind they had also highlighted some plans to expand in the southern markets. So they were adding almost 100 screens, out of which 40% of the screens were in the southern markets. So therefore, given this kind of cap, it could put some pressure on the revenues as well as the average ticket prices, going with the red for PVR Inox.
But I'm sure the industry will challenge this. In fact, a similar such measure was implemented or announced by the government in April of 2017. I was just reading what Karan Taurani, his view is. A similar measure was implemented earlier by the Karnataka government in April 2017 when it introduced a cap of 200 rupees on movie ticket prices across all theatres, including multiplexes. However, the film exhibition industry challenged the decision in court and in 2021 secured a favourable verdict from the High Court, which allowed exceptional pricing for luxury and special formats. But this one will be on the radar for sure. Dixon Tech, that's going to be interesting. Vinny, what's the news and the importance of this development?
Absolutely. So positive news coming in for Dixon Tech this morning. What Dixon Tech has done, couple of news flows. One, they've acquired 51% stake in Q-Tech India. This is going to be through primary as well as secondary investments. And Q-Tech is among the top 5 camera module suppliers globally. And in India, it's the largest amongst this camera module suppliers. Now, obviously, this is a significant step that comes in. Why? Because one, it's that backward integration which the company has been focusing on, and this will add value to that smartphones backward integration that the company has been focusing on. Now, other than that, the second news flow that also came in was that the company is going to be forming a JV with Chongqing, which is a company which is mainly into component manufacturing, precision component manufacturing. What is this used for? This is actually going to be used for components for laptops, mobile phones, in terms of automotive applications, etc., where they can use these components for. Now, this is going to be a 74 to 26 JV. Dixon will be holding 74, and the other company will be holding 26% in this JV. So, backward integration is what the company has been focusing on. And in the recent time, also, they've done a lot of backward integration. They had also made an JV with HKC as well. So that is the focus on a positive coming in there for Dixon Tech this morning.
All right, thanks a lot for that, Vinny. And, I was reading a DAM note that suggested that value addition as a percentage of their mix was at around 15%. They're expecting it to go to 35% by FY27. Good on you, Vinny, with regard to that pronunciation as well. Thanks a lot for joining in. Let's wind this down, though, with Ria on some stocks in the news. Ria, take it away.
Well, yes, Nigel. First up, we're keeping an eye out on Hathway Cable after their Q1 FY26 numbers. This time around, the net profit has jumped up by around 69%, and the strong growth in net profit has largely been driven by other income. Margins have also been driven by dealing in securities and not from the core business of the company. And it's important to note that the cable TV business, which drives most of the revenue for the company, is still loss-making on the EBIT level. So myth set coming in for Hathway Cable. Moving on, Zydus Life will also be in focus today. They've received the final approval from the US FDA for capsules that are used to treat arthritis. So stock expected to open in the green today on the back of that. And the last one is Kotak Mahindra Bank. The president and the chief credit officer of the bank, Mr. Shankar, has tendered his resignation with effect from the 21st of July of this year.
Thank you very much for that. And finally, HDB Financial, the newest kid on the block. Let's see what their numbers showed up. Gaurav?
Well, yes, HDB Financial reported its Q1 numbers, and let's look at it in two perspectives. On a weaker side, we saw asset quality and disbursement, and on a stronger side, we saw net interest margin. So first, let's look at the numbers. Net interest income has increased almost by 18%. This is also reflected in its net interest margin, which expanded almost by 10 basis points. But on the other hand, credit cost has increased again on the back of some stress which is rising from the CV loan, and that is the reason when we look at profitability there, we saw a decline of around 2% on a year-on-year basis. Now, what company has said is that the disbursement slowdown and as well as some stress in the asset quality is because of the CV loans, and on back of this, we will be watching out on the other counters as well. But what company has also said is that the net interest margins are likely to expand even further, and the reason being that 90 to 95% of its book is EBLR linked, and with rate cuts, this will be passed on further in the net interest margins, and that is the reason why they believe that ROAs are going to expand. Let's not forget that ROAs have also come down to 1.9%. But there is an impact of the recent fundraise, and if we exclude that, the ROAs has remained around 2%. So definitely on the weaker side, we have seen some aspects, but on the back of the positive commentary, we will be watching out on this stock.
All right, Gaurav, thanks very much for that. You know, what you do is take a quick commercial break here, but here's a quick recap of the stuff that we put out in terms of stocks. ICICI Lombard, Just Dial, Biocon, Dixon, Zydus Life and Kotak Bank are stocks with some green based on, of course, the news. HDFC Life, HDB Financial, PVR Inox likely to open in the red again based on news flow. Hathway Cable kind of flattish. Well, we'll quickly turn to commodities now. What's top of mind, what's making news, and what's keeping Manisha occupied. Manisha, good morning.
Morning, Prashant. Thank you for that. Well, the energy as a space seems to be doing well. After 2 days of decline, crude oil prices are trading in the positive again. There is improving demand signals coming in from US and China. It is also about strong summer travel, rise in gasoline consumption, and Chinese data coming in better than expectations. OPEC report that came in yesterday also is projecting strong global economy in the second half. And it's not just crude. Within the energy space, you have the coal futures trading at a 5-month high. This is after Chinese government has mandated plants to increase stockpiles by 10%. That immediately has taken the prices higher. But barring energy, everything else is into slight profit taking. Silver, after hitting 14-year highs, has seen a decline. It was down 1% in the overnight markets. Copper prices also are trading 0.5% on the weaker side, and that pretty much is the case across precious metals and base metals, which are trading marginally on the weaker side at this point.
Thanks a lot for that, Manisha. Well, we'll slip into a short break. On the other side, we have Deven Choksi of DR Choksi FinServe, who will join in for some fundamental stock talk. Well, multiplex operators are in focus. The Karnataka government has issued a draft notification to cap the movie ticket prices at around 200 rupees per show across the state. The proposed rule would apply to all theatres, including multiplexes, and cover all language films. The cap is inclusive of entertainment tax. To discuss this and more, we are joined by Karan Turani, the EVP at Elara Capital. Hi, Karan. Good morning. Thanks a lot for joining in, Karan. Well, the stock in focus today is going to be PVR. So if you could tell us what kind of exposure do they have in terms of number of screens, how much of their revenue profitability comes in from Karnataka?
And Nigel, good morning. I think PVR Inox has got a reasonable amount of exposure in Karnataka as a state, largely because of Bangalore being a metro city. If you look at the screen share, around 12 to 13% of the screens are in the state of Karnataka. And if you look at the overall box office market in terms of revenues, if you put regional Hindi languages put together, it is anywhere in the range of 10 to 12% of box office revenue coming from there. So I think this news will definitely have a negative impact on the overall ATP for PVR Inox. 30% is the downward revision. The average ticket price for PVR Inox today is about 260 rupees. If we go by this ATP cap of 200 right now, there's a 30% downward revision on 12 to 13% of your revenue exposure, which means there's a 3 to 4% kind of a revenue negative impact. And in terms of EBITDA, you could see a downgrade of anywhere in the range of 2 to 3%.
This has happened in the past, right? In April of 2017, also, the Karnataka government had introduced this movie cap. What happened then, and what parallels can be drawn from that episode?
So I think even right now as we speak, the order has been passed, but they've given a 15-day window here, for getting public opinions and try to basically see whether or not they should be implemented. So there is some kind of grace period. I think exhibitors will try to lobby hard for this move not to happen. Now, in the past, when it happened, they had gone to the court and appealed. And that time around, this order was rolled back. This was, I think, in 2017. If you look at South as a market now, I think most of the states in South have got a ticket price. If you look at AP Telangana, they have a ticket price more towards 200 rupees. If you look at Tamil Nadu, they had 160 rupees ticket price since many years. So most of the regional markets do have a ticket price cap, which is already there. The bad part for the multiplexes is that the timing, right? So had this come about 6 to 7 years back when occupancy levels were great for multiplexes, some bit of negative impact of ticket prices could have been offset by higher occupancy. But as we're seeing right now, the industry is really struggling for occupancy. There's a structural dent right now. Occupancy levels fail to revive towards more than 60-70% of pre-COVID levels on a steady state. And secondly, also you have to put in the fact that exhibitors are expanding aggressively in the South market. So more than 50-60% of the new screens are coming in the South market, which means that there are more concerns for them. So I think we'll monitor these two things from here on. And if at all this order is passed, it's going to be a huge negative for the exhibitors.
All right, Karan, personally, I'm hoping that a film that releases in Karnataka over the weekend does well. Due disclosures on my part as well. This weekend itself, Junior is the film that I'm looking out for, which is releasing in the Kannada market. That said, is there a risk of contagion? Other states as well looking at this price cap, which as you said, occupancy has been low. And then, in fact, you have a price cap. That's a further dent, right? Do you see that risk playing out, or do you think it'll be restricted to the south part of India?
So predominantly over years, we have not seen these kind of caps in the northern, and the western, the eastern markets. It's predominantly there in the south market as well. So we don't foresee any risk as such of this coming into other states as of now. Why it is there in South is because obviously South, there's a huge fan following. There is a star power. People really want to go, and the government actually wants to make cinema an affordable medium in terms of consumers. And typically because of the ticket price cap, the occupancy levels are almost 1.5, 2 times in the South market as compared to the Northern and the West market put together. So we don't see an extension of this coming into the Northern and the Western belt as of now. But yes, even in South market, as I said, because the expansion rates are so aggressive right now, because you'll see more screen additions in the South market, this will definitely have a negative impact right now and going ahead as well.
So 2 questions, Karan. One, from an PVR point of view, PVR Inox. Now they are planning to expand aggressively in South India, including Karnataka. Will this derail their expansion plan, even if it's a franchisee-led model? And 2, your own target price is 1,100 rupees per share, I think, on PVR Inox. Now you're talking about a revenue EBITDA impact of 2 to 3%. So if it gets implemented, going with that assumption, how would your target price change, and what is the advice now to shareholders?
I think firstly, if it all gets implemented, there's not going to be a big change in terms of target price. The only thing is the valuation de-rating that we'll see for the company. If you look at the EV/EBITDA pre-India's valuations, the revenue has been below par since almost 1 year and a half, right? That's primarily because of content not being consistent, primarily because of occupancy levels not being up to the mark and profitability concerns as well. So we see valuation multiples may not be able to move up beyond a point because the structural dent, it is not like a 1 year thing which will have a negative impact. Things will kind of, come back. Things could have come back. As I said, had this been 5 years ago, occupancy levels could have kind of offset negative impact of the ticket prices. That could have been a scenario. Second thing on the expansion plans, definitely I think they'll relook the expansion initiatives given what has happened in Karnataka, because as I said, because of Bangalore being one of the top metro cities in the country today, they will have to relook at the expansion plans in Karnataka going ahead.
Yeah. The angst mostly on social media, etc., is not about ticket prices, it's about popcorn prices, usually. But yeah, I mean, we'll see if this does go through or not. And it could be, I mean, if it does go through, then it's a kind of a signaling effect in for other states, etc. as well, right, Karan? Possibly. We don't know.
Very low likelihood, because predominantly since many years, 10, 15, 20 years, we haven't seen the northern west market states behave this way. These kind of ticket price caps have only been implemented in south. So it does not have a spillover impact, but because, as I said, regional content has come up in the post-COVID era. Regional content contribution in the pre-COVID times was below 30% for the exhibitors. Today it's more than 40-45%, and even more than 50% when you see a large film like Pushpa coming in. So I think, this will definitely have a negative impact in terms of their box office revenue growth, in terms of the valuation multiples.
Got that. Thank you very much, Karan, for running us through, how to think about this one. So valuation de-rating if it goes through. But we'll, of course, an important point, this is sort of this kind of stuff only from southern states, but we've not seen those from northern western states, which are the other bigger and crucial markets for these companies as well. Devin Choksi is with us at DR Choksi FinServ. Devin, good to have you on the program as always. Thanks very much. Just a quick word on the market itself. Directionally, Devin, do you have a strong view? Is this corrective kind of phase over, or you think there is more to go on the downside in absolute sense?
Good morning, Prashant. Well, I think initially, maybe in the near term, we might see some amount of sector churning. We might see some amount of pressure on some high value stocks. And maybe post-sector churning exercise gets over and the positions built by most of the large players. I would like to think that the market would possibly assume the higher trajectory. Crucial levels at Nifty are 25,200. And I think that level is sustained. Then possibly we would see a continued rally going as high as to around 30,000 in a course of around 12 to 15 months. So certainly the reason to remain bullish is also because of the fact that current year has started on 2 or 3 promising notes. On one side, we have the lower amount of cost structure, which is promising better profitability for most of the companies in general. That's what we are expecting. Second, the business scenario remains absolutely strong and convincing, where the demand outlook for most of the businesses and the companies therein, they look relatively very strong, and as a result of which, we are seeing the growth on that side as well. And last but not the least, the higher amount of inflow of money is also coming into the market. Look at the number of IPOs coming into the market. The flow of money is regular, and more particular going into some of the high growth or the fast growing areas. So in that situation, we believe that the market has a support of liquidity, market has a support of fundamentals as well. And that's where probably we should be seeing the higher trajectory for the market going forward.
One of the important stocks of the day could be Dixon, as it enters into the camera and fingerprint module manufacturing after acquiring a 51% stake in QTech India. What have you made or your team made of this development for Dixon?
Yes, the amount of business that they would be possibly adding into the top line would be significant in the given situation under this acquisition. because it's a 51% acquisition. So obviously the business gets added into the consolidated level. So that is one strong point I think which one can expect. Not completely sure about how much I think improvement in the profit margins that the company would have going forward. As far as I think the buying opportunity is concerned, yes, there may be small upside definitely there in this kind of a news-driven activity. But to me, I think everything is in price. I think valuations are fairly reasonable or fairly stretched, as you may want to call it as. And that's where probably the fresh buying opportunity I don't see unless we trade momentum.
All right. Hi, Deven. Good morning. Good to see you, Ben. We've got a few numbers, right? We've got insurance companies, HDFC Life, ICICI Lombard. From the financial space, we had HDB Financial, first time that they're reporting numbers. You had a look at any of them? Do you like any of those numbers? Any commentary?
Hi, Nigel. Good morning.
Morning.
Well, I guess I think the life insurance business in particular, it remains, I think, a point of attraction to us also, because of the fact that I think in the current year, with higher amount of disposable surplus in the hands of people, a portion of money is going to get into the investment assets, including the protection assets like insurance. And that's where probably I think the new business premium that we are talking about could possibly be on a rising curve. And that's where I think one would like to look at some of the companies like HDFC Life or even SBI Life for that matter, Bajaj Allianz Life Insurance. I guess I think these companies are definitely looking relatively more stable compared to what they have been in the past because of the higher growth trajectory they achieved. However, I think in some of the cases, the valuations are fairly rich. So you are not expecting a very sharp jump. Maybe I think in some cases you might see 15% odd kind of a jump. And that could be, I think, a similar situation along with, I think, some of the consumer finance or housing finance companies as well. But at this point of time, I think the more importantly, life insurance, HDB in particular, I guess I think we want to see how exactly they are implementing the technology at the front end, fintech at the front end, to expand the book size in a systematic manner. Should that clarity come in, I think that it should be, I think, an interesting one to watch out for.
Deven, HCL Tech, now the street is divided. Yesterday's shares were down close to about 3%. Some analysts are worried that this generative AI could be deflationary. Margins will remain under pressure for the entire industry. But there is that other camp which believes that the margin pressure is only going to be, transient. It's going to be temporary. Margins will bounce back and focus on the fact that HCL Tech's revenues are outperforming peers, even though it may be a growth of just about, 4.5–5%. Where do you stand on HCL Tech and the larger IT companies now that quite a few numbers are in?
Well, Rima, I'm a firm believer of one thing, that the technology is going to add into your cost structure in P&L. And I think that is given. Given that situation, whether in whichever part of the world I think you cater to, I think the amount of money that one will be spending out of the business on the technology, I think is going to be a sizable portion. In good old days, I think we used to call it as a raw material cost. I think here out this particular subject is also going to be an operating cost, I think, as far as the balance sheets are concerned, the P&Ls are concerned. So I think I am of the belief that the margin trajectory is not going to be soft. It's going to be, I think, relatively firm, and if not, I think, very high. But it is going to remain firm. And that will apply to most of the IT companies. Now, how they position in their business environment is more important. Those B2B companies, those who are providing the solutions to their OEM customers, in my viewpoint, I think are relatively better placed in form of, I think, getting the larger amount of order inflows and at the same time commanding better margins. Some of the large companies like HCL or Infosys or TCS, even Tech Mahindra, I think they are probably trying to readjust themselves as far as I think the business model is concerned. And in some cases, I think they are successful in driving the AI into their portfolio. In my viewpoint, I think it will be still some time before which I think we see a larger growth coming into their books, the larger companies' books. But mid-tier IT companies, I guess I think they are relatively better placed, particularly ones with the engineering R&D focus.
All right, Deven, final question before we let you go. What's the view on Biocon? If I look at the 5-year time horizon, actually, the stock hasn't given great returns. I mean, it could be flattish, actually. But now they've got that much-awaited approval, insulin aspart, interchangeable biosimilar, which is known as Kirsty. And that could be 100 to around $300 million as per what Ekta just told us. The market size of insulin aspart, I think, is more than $1.2 billion globally. And there's been strong demand. Supply has been an issue as it is. Your view on the stock?
So, Nigel, I think Biocon has always been a very high potential company. And I think somehow that it has not delivered. The main point here in this particular news item is definitely once again ask for a delivery. I think that's where the difference would be. We will be very closely watching this particular development and we'll see how exactly on a quarter by quarter basis we are giving a positive commentary on it. I think for implementation sake. I do agree that insulin market, I think, is a large market. And I think if this company delivers at this point of time, probably I think they will have a game to play in next 3 to 5 years. But wait and see. I think we'll track this level.
Okay, no, absolutely. Devin, stay with us. What we'll do is we'll take a quick commercial break here. We'll come back with some technical trading ideas. Sudarshan and Mitesh are going to be with us. Comes up in just a bit. Okay, welcome back. Flash at the bottom of the screen. HDFC Bank is going to consider a bonus issue along with results on the 19th of July. That should be music to the ears of shareholders. Markets will take note as we begin today's session. That is HDFC Bank, almost at 2,000 rupees. And growth started to come back. And hopefully, as industry growth picks up from those 10% levels, credit growth, HDFC Bank, of course, will get the benefit of that as well. So, bonus issue.
I don't find any history of
bonus. Yeah, I don't recall.
I don't think. Just looking at the exchanges. Yeah. I don't see anything, at least of the recent past.
Yeah, we'll have to see if. It's a long history, right? It'll go back 25 years. 1995 or maybe a little later than that. But yeah, we'll have to check if this is, a first. But we'll see. Not in the recent past, as Nigel said. We'll confirm that. But this is certainly good news for shareholders.
And there's another sweetener, special interim dividend as well.
Yeah, so rewarding shareholders for being patient and sort of, staying with the business, staying with the company. That is HDFC Bank for you. Sudarshan Sukhani and Mitesh Thakkar are with us with a quick technical check on things. Gentlemen, good morning. Great to have both of you here. Mitesh, so 25,000 roughly is basically where we got. Those lows are kind of held. What do you think? With yesterday's bounce, is the small corrective phase over? But I think your view was that maybe there is a little bit more downside here. What's your sense?
Good morning, Prashant. I still maintain that. I also mentioned that the bounce back which could happen from these levels could possibly see supply emerge around this 25, 250, 300 zones, give and take a few points. And I think we kind of got back to about 25, 250. Yesterday was the intraday high, and today we might open with some kind of a negative gap. So in the short term, I think, and as long as we don't get past 25, 300, 320, I think good chance that we'll see the markets again come down, maybe test 25,000 again, and I am still hoping that there will be a lower bottom at around 24,850 out there. So the short-term view is mildly biased on the negative side.
Sudarshan, how would you prepare for today's market opening if we have a gap down? As the GIFT Nifty is suggesting, what would you advise?
Yeah, good morning. Well, yesterday was a buy day and today is a sell day. If you have a gap down, you wait patiently for some small intraday rallies and look to go short in the Nifty. Now, these are one-day trades. Essentially, this means you don't carry them. On the larger picture, yesterday I explained that I'm in agreement with Mitesh. The chances are that we'll slowly see a drift downward. On a day-to-day basis, markets will do differently. Some days are buying, some days are selling. But on a larger, I'll say for the next couple of weeks or few days, we will slowly see the Nifty maybe reach 24,500.
Okay, 24,500. That's 700-point pullback from these levels. Got it. Both of you all sounding a little bit cautious. Sudarshan, you go first. Individual stocks, what's on your radar?
That becomes a problem because only the stocks that come are for buying, despite the fact that the Nifty's undertone is not good. Syngene is a buy with a stop under 643. Hero Motocorp is a buy with a stop under 4370. KEI is a buying opportunity with a stop under 3800. And Petronet is a buy with a stop under 300. Remember, this is for viewers. You don't have to go and rush and buy. You buy them only when the stock or the market stabilizes.
Mitesh, your stock calls?
So I have a mix of buys and sells. On the buying side is HDFC, AMC. If you get it around 5260, which is about 15-20 points lower, buy them with a stop at 5200 for a target of around 5400. ITC is a buy with a stop at 417.5 for targets of 430. A sell on BDL, Bharat Dynamics, with a stop at 1846, move for targets of 1750. And Airtel, Bharti Airtel is a sell with a stop at 1960 for targets of around 1865.
Thank you, gentlemen, for joining in. We'll connect again. For now, it's time for a very short break. On the other side, we'll be pre-opening, and we'll also talk about auto. Auto was the best performing sectoral index yesterday, plus Tesla drives into India. Jay Kali of Elara Capital will join in with his insights. Welcome back. The first rate on the pre-opening is down 120 points in the Nifty. The Nifty is retraced 150 points down, but it's still settling in. Let's wait for that. Let's talk about auto now. Auto is in focus because India's EV space is heating up with Tesla debuting in India with Model Y. The price is set at 60 lakh per car on an average. Jay Kali, Executive Vice President Research at Elara Capital, is now joining in. Jay, at this price point of 60 lakh for Model Y, it's pretty much competing at the super luxury end, your BMW, your Mercedes, etc., and not the Tata Motors and the Mahindra, largely where Tata Motors and Mahindra caters to. So what is the impact of Tesla on India and the listed players?
Yeah, good morning. Absolutely, this is definitely the price point is at the premium luxury end. We know that the luxury market in India is around that 40 to 50,000 units per annum, which contributes to just about 1% odd of the total passenger vehicle market. The price point, of course, is higher because of the duties that are there. And definitely, the entry of Tesla is a positive in terms of, kind of energizing the EV space, given the brand aspiration of Tesla globally, which will, to a certain extent, trickle down to India. But definitely, this is not something that is competing with the likes of some of the listed players that you mentioned in India. And we will have to wait and watch how the duty story unfolds with the India-US FTA or the India-EU FTA, and then how the pricing settles down eventually. But for the moment, definitely a very niche market.
Indeed. What's the view actually on a Mahindra and Mahindra? Normally when we've heard this Tesla news, the stock has pulled back. But the stock has been, technically as well, it's been showing some strength. And it seems the street is willing to look ahead now. Pricing point itself is very, very different. So your view on the stock?
Yeah, I think, we have been of the view that Tesla will come up with the Model Y in India first, and now with the duties that they are, because it is going to be at definitely at a higher price point, which is coming at around 60 odd lakhs. So really no impact on Mahindra per se with these prices. And we have been positive on Mahindra for multiple reasons, like the market share gains that they've seen. Despite industry growth being weak, they've shown a double-digit growth consistently. And of course, tractors is also holding out well. So I think there will be this news flow-driven ups and downs for Mahindra, which has been the case in the last 3-4 months. But I think now it's kind of settled, given that we know the price point that Tesla has entered at.
Generally, I think the BSE or the Nifty Auto Index has outperformed the benchmark. So how are the valuations, if you could give us, of the individual auto names, in the four-wheelers, tractors and two-wheelers, how are the valuations now?
Yeah, I think valuations are definitely, the recent run-up valuations are elevated. The stocks are factoring in a decent enough recovery in the festive season. And we'll have to wait and watch, because the current trends of the first 4 months first 3.5 months have been pretty weak on the demand side. Even recent trends of Vahan retail show quite a lot of weakness. But the expectation is that, with the slew of measures that the government has taken in terms of income tax rate cut, etc., should trickle down to some bit of, kind of a demand revival in the festive season. But definitely valuations are elevated, and one would want to stick to names with minimal expectations of earnings downgrades, if at all.
Yes, Swaraj engines actually the low liquidity, but the street like those numbers. I think the sense is that rural India is still doing better. What is your take? Because, if I look at a couple of segments, the MHCV and all, they're yet to see some kind of a pickup. So how do you view demand on that parameter?
Yeah, I think the rural side is doing well, and that is especially seen. Tractors has been an outlier. I think, in the first quarter, we see close to double-digit growth in tractors. Far higher than many other segments like PV, two-wheelers, CVs, etc. And that has also helped the stock that you mentioned. But going forward, I think FY26 is expected to be a high single-digit growth for tractor industry, led by the rural demand pickup, which eventually we are hoping should translate into good numbers for the passenger vehicle and two-wheeler industry also during the festive season.
Recently, UBS had downgraded Maruti because they're saying that it'll be tough for the company to regain the lost market share. Anyway, the small car segment is, struggling with the price increases that we've seen. And even competition, for the number two, generally competition is also going up. So where do you stand on Maruti? And do you think this downgrade, the points made are valid?
I think the Maruti definitely in FY26 was supposed to be a play more on the industry growth revival and not so much on market share. Because we had seen a slew of launches. There is not a very big launch pipeline for Maruti in FY26. Industry growth is kind of faltering currently, and one needs to see when the first-time buyers come back. I think that will be a trigger for Maruti going forward. Currently, we have a positive view on Maruti Suzuki.
Okay, all right. And a quick word on the two-wheelers. Yesterday, the top gainer was Hero MotoCorp. Yesterday, they had some comments coming in from their annual report. And the commentary said premiumization is their focus, exports markets as well as something they're looking to penetrate in. And the commentary was very positive. Street bought into it. Your take in terms of two-wheelers, and what's it in terms of pecking order?
Yeah, I think in two-wheelers, two-wheelers industry as such is expected to grow at around 7% in FY26 is what our expectation is, much higher than the passenger vehicle as well as the CV industry. So to that extent, we remain positive on the two-wheeler space as well, and our pecking order would be TVS, Bajaj, followed by.
Okay. All right. Got it. Thanks a lot, Jay, for joining in and giving us your take on all of those stocks from the auto pack itself. Well, the markets, I think we have the pre-open rates that should come up for you on the screen. We're just going to be ending, the pre-open session. So just a very, very mild downtick is what we're seeing on that particular front.
Absolutely. And, Nigel, as that Tesla conversation shows, right?
Yeah.
70% duties. Will those duties eventually be brought lower? I think we'll have to wait for that deal, right? With regards to US and India. So here's President Trump. I mean, it's been basically put on, it looked like the deal is moving slower than what most expected. I think that is just a fact. But here is President Trump on the deal with Indonesia, but also, of course, hinting that the deal with India perhaps is being followed through on those same lines. Listen in.
We made a deal with Indonesia. I spoke to their really great president, very popular, very strong, smart. And we made the deal. We have full access to Indonesia, everything. As you know, Indonesia is very strong on copper, but we have full access to everything. We will pay no tariffs. So they are giving us access into Indonesia, which we never had. That's probably the biggest part of the deal. And the other part is they are going to pay 19%, and we are going to pay nothing. I think it's a good deal for both parties. But we will have full access into Indonesia.
Yeah, I mean, that's Indonesia, but let's just play out that India bit as well.
We have a couple of those deals that are going to be announced. India basically is working along that same line. We're going to have access into India. And you have to understand, we had no access into any of these countries. Our people couldn't go in. And now we're getting access because of what we're doing with the tariffs.
Well, all eyes on the contours and when this deal with India will be signed. But let's get in the 9-10 calls. Mitesh is back with us. Mitesh?
I'll go with the sell on Bharti Airtel for targets of around 1865.
Sell on Bharti Airtel. Let's get to some of the big stocks of the day. Potentially, it could be Dixon Tech. Vinny's now joining in.
Hi, good morning. So yes, keeping an eye out on Dixon Tech today. They've acquired a 51% stake in Q-Tech, which is obviously going to be a primary investment as well as a secondary investment. Q-Tech is among the top 5 camera module suppliers globally, and in India, it's amongst the largest over there. Now, this is a significant step that comes in from Dixon Tech, mainly to enable value addition in the smartphone side of the business, as well as they've been doing a lot of backward integration. That's what will add value to the company now. Other than that, they made another announcement that is a company is signing a JV with Chongqing, which is a precision component manufacturing company. Now, Dixon will have 74% in the JV, while the other company will hold 26%. And these components are mainly used for mobiles, laptops, automotive applications, etc. What the company can use these components for. So, backward integration positive coming in here. And obviously, in the last few months as well, they had made HKC JV also, which was a backward integration. So, brokerages are positive on this one. CLSA is also positive on this. They said that this would add value to the smartphone side for at 45 to 55% currently, from 15 to 17% is what it would go to, 45 to 55%. All brokerages are positive on this one. I beg your pardon, and we'll keep an eye out on the stock.
CLSA has high conviction outperform on Dixon. But Sudarshan, pre-open, Dixon suggests a 3.5% up move. Your thoughts on that? And what would your 9-10 call be?
No, Dixon is a buy, but not after a 3.5% up move. I think it'll correct, if not today, soon enough. Petronet is a buying opportunity for 9-10 with a stop under 306.
Petronet. Let's get back to the other stock which should be on your radar. That's Biocon. Ekta joins in.
Well, yes, I'm looking at Biocon because they've received approval for insulin glargine from the US FDA. Now, remember that this is an important biosimilar in their portfolio, considering that they have been awaiting approval for this particular product since a couple of years. They had received a complete response letter from the US FDA citing some deficiencies at the Malaysia plant, which had delayed the approval. This took place in 2022-2023. Finally, they had the US FDA re-inspect the facility in September of 2024. And now they have received US FDA approval for insulin glargine. It's expected to be around $1 billion in terms of sales. On a conservative estimate, Street is anticipating maybe around $100 million in terms of sales, which could possibly even go up to $300 million based on market dynamics at this point in time.
Okay, all right. Ekta, thank you very much for that. Biocon, keep an eye. But let's also talk about PVR Inox once again. We had that discussion with Karan earlier. But what's the Street broadly making of it, Vamakshi?
Well, PVR Inox, it could be a negative implication for that, given that the Karnataka government has proposed in a draft notification that movie ticket prices could be capped at 200 rupees. Keep in mind that this is only a draft. This is not the final verdict on this particular matter. A time of almost 15 days has been given to the public for submitting feedback on this proposed regulation, and the expectation is that exhibitors may rally against, this proposed regulation. Now, keep in mind that this could have a negative impact on PVR Inox, given that almost 40% of its screen presence is in South India. In fact, we spoke to Karan Torani as well, and he said that almost 12.3% of PVR Inox total screen portfolio is in Karnataka. In fact, the state contributes almost 8% to the Hindi box office collections and 10% to the overall collections. And the average ticket price in Karnataka is somewhere around 260. So therefore, if it is capped at 200, it would mean a 30% decline in the average ticket prices, and overall this could lead to a consolidated decline of almost 4% of average ticket prices for the company. There is an expectation that revenue as well as EBITDA could be hit. This hasn't really gone through, but if it does go through, it could have negative implications for PVR Inox.
All right, so negative implications for PVR. Vamakshi, thank you very much for that. So that is the overall picture as things stand right now. Lots of stocks in focus, markets, of course. Let's just look at the GIFT Nifty once more. And by the way, also notice that the rupee, at least at 9 o'clock open, had opened about 12 paisa lower, if that is any indication. So the Nifty is now actually flattened out with the pre-open ending. So it's going to be another, we know, getting used to flatter openings, right? That's the wicks had dropped to one of the lowest ever, the India wicks, that is, over the last couple of days. And we are, of course, now in quieter markets. A much more quieter phase, even as compared to, say, a month and a half ago or so. I think just the rupee, if you can, the dollar rupee, if you can quickly look at it. And then we will just sort of maybe just revisit one or two stocks and then look at market open. 86 or so is where the rupee is at. Yeah, that's a 22 paise fall against the dollar. So that is a big move actually coming through on the dollar rupee past 86, and maybe we should put out a flash as well at the bottom of the screen with what's happening there. The big problem point, of course, has been IT services, and and that's been the pain point ever since TCS reported numbers. HCL Tech followed through with weaker set as well, and there's a big sector still. So eye on that as well. First rates coming through 25,200 on the Nifty. The Nifty Bank is up about 0.25%. And you've got the mid-cap and small-cap indices which will show up as well. But they're flat, at least in the first rates that are coming up on your screen. So not very much at all on either of the four indices that we typically look at. Right out of the gate, stocks are still opening. Maybe it's too early to look at market breadth, but it's kind of evenly matched as we begin this particular session. Just a quick heat map, which will give you a snapshot view of how many are up and down in the Nifty 50 stocks. So it's mostly all about 40 odd names are lower, and you got about 11 names which are actually higher at this point in time. I can spot some financials at the bottom of the screen, so let's get to stocks. Rima.
Well, the top gainer is HDFC Bank. The street is excited with the bonus announcement. Stock is up 1%. HDFC Life, top line looked good. Margins were a bit subdued, but the stock is up and about in trade. And SBI Life, that too is moving up in company. SBI Life is a gain of nearly about 0.5%. HCL Tech was the top Nifty loser yesterday. It fell by more than 3%. There hasn't been a recovery in HCL Tech. I don't think it's fallen more, but it's a flat opening for HCL Tech after yesterday's fall. On the way down, Reliance Industries is struggling. Remember, it comes out with numbers on Friday, post-market hours, and ahead of that, Reliance is under pressure. Shriram Finance is seeing a big fall. In fact, that's the only one with a fall of more than 1%, and it's straight away 4% gone on that. Did I miss the news on Shriram Finance? 4% down, large volumes. And no other stock is showing this kind of an exaggerated move either, on the way down. So at least Shriram Finance is, seeing a big fall. Outside of that, Cipla, Bajaj Finance, Hindalco, JSW Steel, and ICICI Bank. Metals too appear to be a tad on the back foot.
Well, that's right. A few stocks in the broader markets that are catching your eye. Coffee Day, the stock is up 10%. So big volume out there. That's coming up one of the top volume movers. Biocon, the stock has relatively underperformed if you look at it for the last few years. But now that biosimilar getting a green signal, the street likes it. And that's why, in fact, that stock is up and about in today's trading session. Hathway Cable opens up with a gain of around 4%. Network 18 is up close to around 5%. Due disclosures, please note. Both those two are doing quite well. Edelweiss Financial, well, that one as well is up close to 2%. These are all the top volume movers. HDB Financial, that's reacting negatively to its results. I think we should get that one as well up for you on the screen. It's seeing a 2% downtick. And Diffusion Engineers, that's one of the new listings out there. That's up close to around 5% as we speak. So good up move is what we're seeing on that one, on fairly large volumes as well. In terms of losers, I think Shriram Finance, that's the one that's calling for attention. And Newlin Laboratories, I think this week it's up 20%, even after the 4% pullback that you're seeing. So some kind of cooling off after the big run, as is the case with ITD Cementation as well. Stock now down 3.5%.
Absolutely. So it's quite a start. Nifty, the bank's index is doing much better. With 57,130. The Nifty is slightly lower at about 25,160 at this point. Small caps are doing up. They're up about 1/3%. Maybe if you can just quickly look at the IT index, and then we'll move on as to see what's happening in the rest of the space. I mean, IT index absolutely flat for now. Let's welcome in our market master of the day. Samir Arora is founder and fund manager at Helios Capital. He's with us. Samir, great to have you with us as always. Good morning. I want to start with exactly that, which is IT services. I mean, you've had this pet peeve for a long time with IT and their acknowledgement or lack of acknowledgement of the disruption. Let's just start there. What you made of the earnings and go on. Yeah, please.
I think more than that. First big goof up is that not to invest in any new technology, helping others, do this. For example, if you've heard of a company called Zscaler, founded by two Indians, those Indians are worth combined husband and wife some $18 billion. To see all this happening and to help others, but because of this fascination with cash flow and dividend yield and buyback. So, we are stock market guys and we like people who care about stock prices. But still, there has to be in not 1 year, 2 years, now 20 years have passed to not make $1 worth of investment in all these new technologies happening in front of you, not in front of us, but in front of them. To not do it is very disappointing. Second thing is, as I said, lack of acknowledgement, which actually distorts many careers. Because even today, if you keep saying everything is good and you don't openly discuss because next quarter price might be down, how many people are now learning coding when you know that the coding job will be 1/3 say, I don't know, say half, whatever. 10 years later, 5 years later, you have to guide the world a little bit every day to only focus on what is, to delay. I have delayed my hikes because this quarter margin will be lower, higher. I mean, this is overdoing. If you have to give it now, how does it matter that this quarter my margin will look 10 basis point lower, but next quarter I will save something on travel, so I will give a hike. I mean, this is just over catering to the market, which otherwise I like. But they are disappointing on many levels, philosophically and on a day-to-day basis.
You think at some point there will be a pivot, and you will, as investors, I mean, at the end of the day, viewers want to know whether they, money can be made here.
Of course, I will do it, and then I will come and confidently tell you why I like them at that point of time. But the point is, today I don't, and I haven't. And this issue is a bit serious. So this issue is, you can say, like the consumer staple guys. You are still the best companies, big companies, important for country, important for foreign exchange. It's just that your growth is gone. And when the growth is gone, you try and find all these bad, I mean, sort of in hindsight, you can call it, I don't care. But right now it is bad. So there is no point in saying that, now it's too late. It's not late, according to me. And we are not just telling you, you can see our portfolio, what we have and how much we have. And we also don't like, 3-4% kind of growth. Who cares for 3-4% kind of growth? If that is the case, then maybe the PE should be like HPCL or something 5. Then you might say, okay, doesn't matter. One day something will happen. But if you're already trading at these valuations, then you don't want 2 years of 5% growth, because one day it might become 6 and surprise everybody. That's too boring.
Okay. IT is boring. But other than that, you like the market, you said.
I like the market. I have broadly liked the market. In between, there was this confusion that I had on this India-Pak war and all. But this time we realized that, these things get sorted. Unless they become very bad, then of course that is a low probability event. But generally, these things get sorted in 10, 15, 20 days. And then sort of the rebound is at least half to 80% and move on. So I've been bullish on two things for India, that is. One is that for last 6-8 months, not now, but say 2 months ago, from say September onward, there were big FII outflows driven by people feeling that they should go back to US. And so in September and January, there were very big sales of maybe more than 25 billion or so in 2 months. I mean, in these 2 months, not together. And then since April, May, it is clear that the world is not fascinated by US to the extent that they want to put back everything that they may have sold. And you can see that from flows into ex-US ETFs. There's a MSCI World ex-US ETF. There were articles on how many billions it has got suddenly. Even we in our global fund have reduced US weightage from 70% to 50%. And the world there's so many things you can read on that the world has slightly brought down their US, if not this much. For the first time in many years, the ex-US index is beating the US market. And therefore, if that happens, and there is a shift of 3-5% from the current US exposure of 70% to say 65%, 68%. That is massive money for the rest of the world. And in that, India has a strong case. India has a case in terms of inflation and interest rates and liquidity. And so even if we just don't get outflows, and plus the currency dollar is depreciated, so that's another reason why people don't like that much US. So if that happens, then just by not having outflows will be a big positive compared to what we have seen in recent 6-8 months.
So, Samir, you said that in your global fund, you've brought down the US exposure from 70 to 50%. Yeah. So which other markets have you deployed that money into, and how much?
So we used to have this, by the way, fund went from 70 to near zero. Fortunately in Feb, so it has been brought back. So what we've done is we used to have 5-7% in China, which we are now targeting, still haven't reached, but 15. So we are at 12 or so, and we did not have gold in that fund. I used to personally own gold, but in that fund now we have already bought 5% gold. And we are going to keep these forever now. I mean, ever means, let's see. And then the rest is in, we had these 8-9% in these two Indian ADRs all our life, which have not helped, particularly, you know which one. I hope one day it helps, which is HDFC Bank ADR. And the rest is rest of world, 20%. So 50, 15, 5, 10, and 20.
All right. Hi, Samir. Good to hear you this morning, and thanks a lot for joining in. Samir, what about, the Indian economy? How are you reading it? Because urban India still appears like it's very, very slow. If you look at, numbers coming out of Trent and the likes, which one would say is a little bit worrying. However, inflation has cooled off. And if I look at the nominal GDP, it's going to be sub 10% in all probability. So one way to look at it is the RBI is going to pump it up even more. We're going to get further rate cuts, which in turn could be the start of a fresh leg on the up move. How are you reading these data points that are coming in there?
So right now, if I look at it purely from earnings point of view, earnings are not great. As in this year, you can't grow more than 10% here or there because IT growing below 5 maybe. The large consumer companies growing 4-5%. The large banks or banks in general growing below 10 because of NIM compression and all that. But at least that one hopefully gets sorted out in 3-6 months. So for this year, whether we are positive because of flows, we are positive because of interest rates, we are positive because of SEBI and RBI being pro-market in some sense by reducing some regulation, putting in liquidity here, there. Still, you can't make obscene money, which would, according to us, be 20%. So you will make 10-12%. If you see now year to date, the market is up some 5-6%. So more or less, 0.8 to 1% per month if you get, that is enough. So that issue is there and you need a new cycle of something or some of these to do better. This negative overhang of IT is also actually going to over time feed into our consumer sector. So it's not straightforward, but 10-12% return is still reasonable to expect for some time. And they're hoping that some of these things, either because of pumping of liquidity or interest rate cuts or whatever, goes back to a little higher than they are now, and therefore the overall market growth is about 13-14%, which is sort of normal. Right now it is below normal.
No, absolutely. I got that. By the way, Samir, there is, with regards to what the RBI wants to do, what we've been sort of hearing, picking up, and there was the RBI governor interview yesterday as well. I mean, they're very, and we've heard from the horse's mouth, but also generally feedback, people who go and give suggestions, etc. When the RBI wants suggestions, I mean, it seems to be squarely focused on growth. I mean, asking banks, tell us what you need. And they're very focused on kickstarting another credit cycle.
Because we need it.
We need it. So if they're successful, even mildly successful, where will this show up in your way from an investment point of view? How do you connect it?
So as I said, the first thing is that in financials, we expect that the growth rates will go back. That is in the banks and all. I'm still a little bit hesitant on our own sub-segment, which is capital markets, where again, we are getting carried away that every day the volumes have to go up and depository accounts have to go up and all that is, we are over pushing it. For example, I saw on Twitter somebody saying that BlackRock has some 12 trillion, therefore the asset management companies in India can grow forever. I mean, if this kind of wild connections are drawn, even though we ourselves own HDFC AMC and of course we own our own Helios AMC, but still, you don't want to overdo these things. But before that, India, as of now, also seems to be a relative beneficiary of the US trade deal, because at least so far it has not happened. And if we finally get some 15% even, then all our competitors, China has 35 right now, 10 plus fentanyl, Vietnam has 20, Sri Lanka has more. Also, all these similar guys, Japan has 25. So even if we get below 20 anything, I hope we get 10, but let us say that looks a bit very optimistic right now. That also will be on the margin positive. So overall, it's okay. But in terms of the portfolio, we are still in the same old, which is financials and discretionary consumer a little bit. And then a few here and there you can see in different places, but no. Because there are three big pockets: consumer, IT, financial. And if you don't have IT, that leaves a big gap. And therefore, you have to cover some other angles to spend that money or invest that money.
Samir, any new idea that you want to talk about?
No, we don't want to talk about because
Stock as an idea that you
can
want to
see them in the mutual fund disclosures and you can talk to the mutual fund manager or that team.
But I think the Flexi Cap Fund has made 4 additions in June. Siemens Energy India, Vishal Mega Mart, Niva Bupa Health Insurance, and Swiggy. So
I'm delighted to hear that you are reading your sister company's articles.
Yeah.
Control. You should have your own articles.
Oh, who told you that's not our article? That's our article.
I also saw it today morning on Money.
No, Samir, you're wrong. We are reading our own content.
It's your own company, actually. Point is, by the way, the Flexi Cap is doing very well. If you see it from, Jan was bad, but overall, if you do 1 year since inception, 1 month, 3 months, since February 1, it would basically massively beat the market. If you see it from inception, it would have beaten by more than 9% in less than 2 years, which is quite big and bigger than the biggest guys who are more in the news every day.
I got that. Do you think, one thing I've heard from many is insurance. I mean, again, we've spoken about financials, but insurance perhaps, in a way, does better and better. The last 2 years, again, like many others, lots of regulation, lots of changes, but now it's settling in. We, of course, still are waiting for the new IRDAI chief, but they perhaps will be a little bit of a pivot, more friendly to industry, etc. Any thoughts?
So we have 3 actually now in all our funds. HDFC Life, and we bought this Nuva Bupa, and we also have ICICI Lombard. And the first reason was that they had done very badly. Like HDFC Life in the beginning, after a very successful IPO and all its returns being made in the first 2-3 months, I think. Basically, for 3-4 years, the stock market performance was ordinary to zero, and then the fundamentals caught up. And big picture is positive for this theme and this sector anyway. So if the theme is otherwise good, you just buy the obvious candidate also is enough sometimes. And these are the obvious candidates in this field.
And I think Bajaj Finance as well, you're topping up out there, right? That's
Bajaj Finance, we are topping up means actually that topping up is because that fund gets new flows.
Oh, okay.
But otherwise, all are buying. We all have it. Even I have it here. But the topping actually in some sense sometimes doesn't show. Sometimes doesn't show. We are very positive, very bullish. But what I'm saying is every move in a mutual fund, you should take a little differently from, say, some other fund which has, sort of a more or less a regular size rather than like the mutual fund getting every month. Mutual fund is a good business, I must say. Every month the flows are very big and it is very heartening and pleasing to see that every day. But that also means that you don't interpret every stock trade as a new something.
Samir, quick word on gold, because that's, as you said, the recent addition, at least in the global front. You've had it personally. Yeah. I mean, it's had such a phenomenal run. So it's very hard to make that argument that those kind of returns, or smart returns, will continue even in the future on that kind.
Actually, the thing is, this is the whole story which nobody knows. That the whole reason for being, not whole reason, but one of the reasons for being confused about US by the world is that the US debt is unsustainable. If you read this Ray Dalio book, Why Countries Go Broke. So all these things will lead you to believe that it is okay if you don't make much money on gold, but you don't want to have a situation where the currency in US goes a lot. When Ray Dalio says that in 3 years, US will have a seizure plus minus 1 year, and he has written a whole book basically to lead to that conclusion. And we can see that the world, there is not enough of an alternative, as in if you don't like the US dollar, it's not that the world likes euro or the world likes yen or they believe that those can take over. But gold is a neutral this thing, and it is, you can say, insurance, but also it's a hedge, you can call it, whatever you want to call it, to against the fact that the US goes bad. And, of course, recent days, the US market has done well. But every time these tariffs were increased and uncertainty was increased, and basically President Trump was very aggressive in criticizing other countries, for example, saying they are coming here to kiss my ass or something. So all these things would make you feel that these other countries will try, if they can, reduce, limit, but at least definitely not overly support the US Treasury.
You could have said, just kiss me. Kiss me.
So I'm saying every time it looks to me that the word which was friend of US might say, now it is deal to deal, trade to trade, and just randomly putting everything in the US, if they have surpluses, all that is changing. Whether it is for fundamental reason or personality reason or, ego reasons of everybody.
Laughter in the morning, Sameer. I mean, that's what the conversation with you always leads to. Lots of gyan, insights, but really some laughter as well, which all of us look forward to. Thank you very much for joining us. Great speaking with you, and appreciate your time here on CNBC TV18. I think the market's not doing very much, 50 odd points lower, 25,150. But, the deal pipeline, Reema, Nigel, in terms of blocks and IPOs, etc., supercharged.
Indeed. So let's straight away get to, the big block deals. The most recent one was the one that we saw in VIP, where Multiples and Sancheti Brothers picked up about a 32% stake in Piramals. But there have been so many others, and the IPO pipeline continues to remain red hot. So to decode the key drivers, the trends, the pipeline, we're now joined by Bhavesh Shah, Managing Director and Head of Investment Banking at Equirus, and Rahul Modi, Managing Director, Co-Head of Investment Banking at Ambit, joining in. Gentlemen, thank you very much for joining in. So just to first understand, the numbers in the first half of this calendar year, and what the numbers in terms of M&A and IPO pipeline that you guys see in the second half of the year. Bhavesh, you want to go first?
Sure. I think, Reema, thank you, first of all, for having me on the show. We are seeing a lot of activity across the board, be it IPOs, be it M&As, be it block deals. This is a investment banker dream that we are all living. We all grew up as analysts to where we are today to see this kind of an activity. But if you were to really look at it in terms of numbers, I think M&A was something like $25 billion year before last, but it's now become about $30 billion in 2024. What we are seeing is a multitude of game change in terms of optionality, which the companies have. Today, they can actually list the company. They can actually, sell their stake through block deals, not necessarily through an M&A, but also an M&A is an option. So it's a multitude of options which is available for the companies, and that's how the trend is looking at in terms of numbers, etc.
All right, good to see you, Bhavesh, as well as Rahul. Thanks a lot for joining in. Rahul, let me come across to you. The recent few deals, SML Uzuzu, you have the deal in the pain space, Saxo Nobel, and recently VIP as well. All the three deals, they're viewed very, very positively, and they're large-sized deals as well. However, one would say that all the three deals got done at a sharp discount. How are you reading it? One would say it's good for the industry, good for the country on the whole. However, do you think some of these were distressed sales? The promoter entity out there was a little bit more desperate to get out of the business?
First of all, thank you for having me on this discussion. No, I wouldn't say so. I think each deal has obviously very specific deal dynamics. So I wouldn't generalize or say that they were distressed deals. Obviously, you have to consider where and I think a number of deals you mentioned are publicly traded, and obviously the markets and the valuations have been quite good. And it's quite normal for some of the secondary deals to be priced at a discount. So I wouldn't say so.
All right, Rahul, fill us in with your view then. How's the pipeline looking? If the markets remain very, very buoyant, then this deal street is likely to keep buzzing. Your take?
Absolutely. So, see, as Bhavesh said, I think we are seeing a very significant activity both on the M&A private capital raise as well as public markets, equity capital markets. The volumes on the M&A side have been quite robust. And I would say there are maybe identify four drivers for this. One, which is very basic, is I think we had great last year in terms of the equity capital market performance. But that was corrected a little bit earlier this year, initially because of this whole global tariff situation and a bit of geopolitics. And what that did is had some correction in valuation. Obviously, markets have gone up since then. but that makes the deals between buyer and seller and agreement on valuation more possible and pragmatic. So that's a very key driver, I would say, for M&A surge this year. Secondly, if you see, and in fact, you named a lot of the deals, but if you see one theme that has emerged is the large corporate houses have done, very meaningful M&A. So if you see, you mentioned JSW, ExxonMobil, Bajaj acquired Allianz's stake. Mahindras have done a few deals. Torrent did JV Pharma. So, there has been a spurt in activity from large corporate houses. Thirdly, private equity has been pretty active, both on investments as well as exits. And some of the exits have been through IPOs and blocks, but some have been through M&A and secondary sales as well. There has been focus on control deals from private equity. And it's not only the traditional private equity houses. You see real estate funds, infrastructure funds, pension funds, sovereign wealth funds also participate. And lastly, and again, that's something you touched upon, is that while even if they've corrected, the valuations are still good. So what we are seeing is, monetization by some Indian promoters or even foreign strategics. So you mentioned about VIP deal. We know the ExxonMobil deal, but there are a couple of Whirlpool is there. There is Novartis. So I would summarize all these four factors are contributing to very robust M&A pipeline.
I did a couple of these discussions, and we spoke with Ramdevji as well. And one thing he said kind of stayed with me. He said, well, so much supply essentially means that perhaps it puts a bit of a cap on the higher side, but a lot of the money which is being taken out, I'm talking about exits from PE, VCs, promoters, etc., a lot of it basically comes back into the market. So that kind of also provides some sort of a floor as well. So PE and VC exits last year were about 1.15 lakh crores. This year so far, this is still the 3rd of July, that number is close to about 40,000 crores. And of course, promoter exits 2 years in a row, 23 and 24, a lakh crore plus. And this pace, we're at about 65,000 crores already. I think we'll beat the last 2 years as well. But I just want to quickly get for our viewers, Bhavesh and Rahul, right? As they say, buyer beware. Deals will come, and promoters and everyone will try and maximize. Where is all this stock going? It's going to DIIs, and DIIs are buying because they're getting all this money from retail investors, local investors in many ways. The quality of paper, I just wanted to quickly, if you both want to weigh in for 30 seconds each, Bhavesh, in this cycle where we are right now, what do you make of it? What's coming to the market?
So Prashant, I think it's a very fair observation, and obviously great amount of activity happening, which also leads to the question as to whether it's really good quality paper coming into the market at the cost of the retail investors. But I must tell you one thing, is that the mutual funds, the institutional investors, that is, they have significantly upped their game in terms of the processes, in terms of the work and the diligence that they do in identifying the companies or where they want to invest, and the pricing as well. There's an extreme amount of discipline which is there. And I think it is but natural, because all these institutions have scaled up significantly because of the money coming in. Every mutual fund wants to grab a share of this 27,000 crores which is coming in. So they better be sure about what kind of companies they're investing in. Are they making good returns or not? So there's a
Bhavesh, absolutely, point taken. But as I don't know if you heard Samir earlier, right? Towards the end, he said one thing. He said, because we are getting this gush of money, so anything we do, don't take that as this new kind of big view. You just you're getting the money, you got to put it to work. So while I take your point, but it is also just a function of the fact that you can't sit on cash. You're being given money, this gush is coming in, and you got to put that to work.
And exactly, which is why this supply of high quality paper really helps. And if I were to correlate this to M&A, for example, earlier a large stake sale in companies would invariably have to be done through strategic. Now strategics will try to really bring the valuations down, or kind of arm twist on the valuations. But now with the markets opening up, with the private equity opening up, the optionality of good quality paper coming at reasonable prices has also kind of, come up significantly. So the incentive for the companies to go for markets rather than do a strategic is there. At the same time, there's a good supply paper coming in, which kind of absorbs this liquidity in the market.
Rahul, have you seen a distinct increase in PE-led acquisitions or consolidation? So the most recent one was Multiples and VIP. Then there was Temasek-backed Manipal acquiring Sayadri. Before that, Bain Capital invested about 18% in Manappuram. So compared to the last, say, 3-4 years, have PEs become more active in India?
Yes, absolutely. I think, and it's been very steady. So if like last year, maybe just the PE investments were $30 billion. And we see this year tracking that and probably doing a lot better. As I was mentioning, we see a great level of confidence in PEs across sectors. They are willing to do more control deals as well as significant minority deals. And this confidence comes from economy in general, the business case of particular investments, but also their confidence in exits. And I think, as Bhavesh mentioned, you have multiple options to exit now. So we're definitely seeing that, and it has been across sectors. Consumer, we've seen a couple of very large trades like Haldiram, Theobroma, which got announced very recently. There are a few in pharma and healthcare, KKR acquiring HCG and so on. So other aspect of this is that it's not only the traditional sectors, but there is a lot of capital that is coming into real assets, so real estate. So Blackstone acquiring properties in Kolkata. Infrastructure has been very prolific for the last few years, and I see that continuing. As you know, there has been extension of certain tax benefits which are attributed to pension funds and sovereign wealth funds, which were extended by full 5 years in this budget. So that story is going to continue in every possible infrastructure, roads, renewable, digital infrastructure, energy infrastructure, and so on.
Yeah, I mean, that real assets story, right? It's very, very small right now in India. I mean, if you look at the sort of market cap of, say, REITs as an example, compared to how large that market is in the US. But maybe things will pick up on that particular front as well. We're out of time. I had a couple of more questions, but maybe we can request both of you to come back on the air. Bhavesh and Rahul, appreciate you joining us here on CNBC-TV18. Thank you. We'll take a quick commercial break here. We'll come back. We'll have the management of ICICI Lombard join us on the other side. We talk about their quarter numbers and, of course, the outlook more importantly. Okay, welcome back. ICICI Lombard is the next management as promised on the program. The stock's higher. It was high yesterday after it reported good set of numbers. Net profits have risen 28% to 747 crore rupees. We are now joined by Gopal Balachandran, Chief Financial Officer at ICICI Lombard. Thanks very much, Mr. Balachandran. Good morning. Prashant here. So if you look at the net earned premium growth, that is in line. But if you look at the PAT growth, as I just mentioned, that is much higher, 28-29% kind of growth is what we've seen. Could you just briefly tell us what led to this very sharp move on the bottom line front in the quarter?
Morning, Prashant, and that's a great question. I think from an ICICI Lombard standpoint, I think we have maintained it even in our earlier calls. As a company, what we have tried to do is to stay focused and be disciplined in terms of our insurance outcomes. And more importantly, also kind of leverage the investment float that we kind of generate in our business and put it to optimal use. So the number of 28% growth that you see, I think the markets have been kind in the quarter. And therefore, to that extent, whatever growth that you see is a combination of both an improvement in our insurance results, which is largely reflected in the combined ratios. And equally, obviously, there has been an improvement in our overall investment income. A combination of the two is what has led to a growth in profits of 28%. But as we keep saying, I think some of these, how sustainable, I think better is to always keep looking at results more on an annualized basis. That will be far more reflective of what one can expect insofar as the full year operations are concerned.
Mr. Balachandran, and that was exactly my question, because during the quarter, because we get these monthly numbers, right? Except, I think, retail health, across all other segments, ICICI Lombard sort of gave up a little bit of market share. So is this performance sustainable, or do you think we will eventually see deceleration in premiums as well as we go through the rest of FY26?
Again, that's a great question if you ask us. I think that again, let me just put this in context. I think let's look at in terms of where the market is currently positioned as. One is in terms of what is it that you can exhibit as top line growth. And the second, what I said, what is it that one can exhibit in terms of profitability outcomes. If you look at the overall market, the industry is kind of currently losing roughly about 12 to 13 rupees for every 100 rupees of premium that you collect. So which is why the industry combined ratios are operating at around 113%. So when there is so much of underwriting losses, I think from an ICICI Lombard standpoint, what we have always tried to do is to obviously accelerate in segments which we think are preferred segments at this point of time. At the same time, be guarded and cautious and wait for the cycles to turn around and obviously seize the opportunity for growth as we head into the subsequent quarters. And that is how we always operated as an institution. And that's the reason not just now, given at any points of time, generally, if you see relative to the industry combined ratio numbers that I spoke about, ICICI Lombard's combined ratios have been kind of better by at least about 10 percentage points or thereabout. And to the markets, what we have been largely talking about is to see how we can continue to deliver a sustainable return on equity in the range of 18 to 20%.
Okay, all right. Hi, sir. Good morning. Good to see you, Ben. A couple of quick questions then. So you're saying that you'll outgrow the industry and the combined ratio as well will be far better. Could you put a number to that? What kind of industry growth are you working with? I think in the past you've said that you'll outbeat industry growth by 100 to 200 basis points. So do you hold on to that? Are you looking at any kind of price increases as well, price tweaking? Give us clarity on both those two fronts.
Again, Nigel, I think that's a great question if you ask us. So again, let me just put this in context. I think when we had kind of talked about us outperforming on growth, exactly to the numbers that you indicated, which is about 100 to 200 basis points, that's relative to, let's say, where the market is expected to operate at. Vis-a-vis that, what we are seeing at this point of time is obviously elevated levels of competitive intensity. And therefore, to that extent is what I kind of talked about, to be a bit guarded or cautious. And in that context, I think we are happy to kind of let go market share, particularly around these times when the market remains elevated. Having said that, obviously on the segments where I think things have been reasonably good for us in terms of the pricing regime, I think we have continued to stay accelerated, whether it is growth in our retail health book, within the commercial lines, whether it is a growth in the SME segment, I think that continues to do well. Within the motor segment, if you were to see our shift in mix to private car relative to, let's say, commercial vehicles. So that's how we have kind of obviously kind of moved across business lines, depending on what environment that we are seeing in the market. The second point on Where do we see the price? I think the good part is, again, let me kind of pick each of the segments. Commercial lines, if you recollect, last year had a tough time in the pricing market environment. This year, clearly, if you see the numbers, that is reflected for the overall industry also. The pricing seems to have kind of come back reasonably well, though not fully to our expectations, but there has definitely been a price improvement. On motor, I think there has obviously been from an industry an ask to possibly seek an increase in third-party price. We will wait and see when that final notification comes through, and we'll be happy to talk through whenever it happens. But in general, there is definitely a need for price increase in motor because industry combined ratios on motor are operating at 124%. On health, I think again we have spoken about from an ICICI Lombard standpoint, the loss ratio range on an annualized basis, which we are comfortable with, is between 65 to 70%. And at this point of time, looking at how things are playing out for us, it seems to suggest that we should be within that range.
Sir, twice, thrice you referred to elevated competition in the industry and how one needs to be guarded. Can you describe a little bit more about what we're seeing with respect to the competitive intensity and what's the extent of market share loss that you've ceded? What's the number?
Yeah, so again, if you look at it, let's take individual segments. Let's take motor. We would have lost roughly about 0.5% market share. We touched almost close to about 11.1. As we speak, we are at a market share of 10.5%. And this is not just this time, Rima. I think in general, I think our approach, which is what I talked about, when I said the industry combined ratios in motor is at 124%, that is a lot more money to lose even relative to, let's say, the aggregate. What I said, industry is losing about 12 to 13 rupees for every 100 rupees of premium that they collect. So in motor, you're actually ending up losing almost 25 cents to a dollar. So that's a lot of money to lose. And therefore, in these times, it is far more important for us to make sure that we continue to stay invested in our service/distribution expansion initiatives. But at least insofar as growth is concerned, at an aggregate level, you will possibly see us underperforming the market. But this is how the nature of the business works. And hence, to that extent, I think we will obviously be able to kind of position ourselves far better. Whenever the cycle reverses, we'll be able to capture the opportunity of growth.
Are you comfortable losing more market share? I mean, what if the cycle doesn't reverse? You've already lost 60 basis points in motor, for instance. I mean, what is your plan B or the thinking behind it?
Absolutely. I think this is again, I think I would again kind of put this in the context of, because the informations are all in the public domain. I think companies which have tried to be very aggressive, again, if you would have seen over the last 2-3 years in specific, clearly you have seen them significantly getting impacted in terms of their combined ratio/profitability outcomes. And today, if you were to see the growth numbers of some of those players, they have significantly calibrated growth. And in some of the instances, they've actually kind of degrowing their book. So that's exactly what happens. Particularly when you start to see your combined getting impacted, profitability is getting impacted, solvency getting impacted. So that's exactly the nature of the business that we are in. And over a period of time, and just to kind of refresh quickly, in motor, while I said currently we're at a market share of 10.5%, post-COVID, actually our market share came down to 9.5%. But since then, when we saw an improvement in pricing, we were able to improve the market share from 9.5% to 11%. And today, I think again, when the competitive intensity is far more elevated than what we would have expected, happy to stay guarded and cautious and wait for the cycles to reverse.
Very quickly, sir, you said you're going to be shifting more towards private in the motor segment. What is it at? What is the mix currently? Very quickly.
The mix for private is about 55%, two-wheelers is about 27%, and the rest is commercial vehicles.
Okay, all right. So you're saying greater focus on private, right? So the number goes to what?
So Michael, again, let me just put this in context. This number is for the current quarter. Okay. If the market environment changes, this mix can completely undergo a change.
All right. Not out of questions, but out of time. Thanks a lot for joining in. We look forward to having a chat with you, maybe in the middle before the next quarterly numbers.
Thank you, sir.
But it's time for our special segment, Quarter Se Quarter Tak. We bring you expectations from each sector. Today, Upasana is going to tell us how the expectations are in the consumer durable space. Upasana, over to you.
Consumer durable companies are expected to post mixed growth trends in Q1 FY26. During the quarter, cable and wire segment witnessed a robust growth led by strong volume growth and price hikes. Now coming to EMS companies, this pack continues to outshine as demand tailwinds continue to drive growth. On the flip side, AC players are expected to witness a weak Q1 owing to delayed summer and early monsoon disrupting their overall sales. Now coming to cable and wire players, strong growth momentum is likely to continue and exports are expected to pick up. Cable and wire volume growth is expected in mid-teens, indicating a solid start to FY26. Strong execution of government-led projects, steady demand from real estate projects, and a pickup in exports should drive robust growth during the quarter. Now, Motilal Oswal estimates aggregate revenue growth of 17% in Q1 FY26 versus 11% seen last year amongst these players. Given the volatility in the commodity prices during the quarter, it estimates cable and wire margins likely to be flat on a year-on-year basis around 11.3%. Now, amongst the players, Polycab is expected to report highest growth of 17% on a Y-on-Y basis, followed by KEI Industries at 18%, while Havells and RR Kabil is expected around 15% of a revenue growth on a Y-on-Y basis. Now, Motilal expects margin expansion for Polycab and RR Kabil, while margins are likely to contract for KEI Industries and Havells. Now, coming to RAC and other appliances segment, weak summer affected the demand for RAC and other summer products. Industry demand for RAC is estimated to decline by 20 to 30% in Q1 due to high base, disrupted summer, and even aggressive channel stocking seen in Q4 FY25. Industry leaders such as Blue Star and Voltas full-year growth guidance remains intact as they are hopeful of making up for the lost demand. Also, Motilal estimates UCP segment revenue to decline by 16% for Voltas due to decline in their RAC and air cooler category, and 14% decline is what they estimate for Lloyds. In ECD segment, Kotak estimates 5% growth for Havells, while Crompton expects a decline to be offsetted by double-digit growth in pumps and appliances. Now, coming to the main EMS companies, they are likely to outshine with their strong revenue growth trajectory and aggregate revenue growth of nearly about 51% on a Y-on-Y basis in Q1 FY26. This is mainly aided by healthy demand across end-user industries and even strong order book execution. All EMS players are likely to report revenue growth, barring Syrma SGS. Dixon continues to lead the pack with strong and anticipated revenue growth of 82% on a Y-on-Y basis, followed by Keynes at 50% and Sign DLM at 7%, and lastly, Amber is estimated around 6% on a year-on-year basis. Overall, EBITDA margin is likely to contract for this pack by 10 basis points on a Y-on-Y basis, led by margin contraction in Cyan DLM and Amber. So let's see what holds for consumer durable as a category, but overall we are expecting a mixed growth trend.
Okay, all right. Thanks a lot for that, Upasna. Well, we have Praveen Sahai, the research analyst at PL Capital, who joins us on the show. Hi, Praveen. Good morning. Thanks a lot for joining in. Well, first up, we have some news flow on Dixon overnight with regard to their JV that they've done and that small acquisition as well. How does it change things for them? If you could put a number to the EPS upgrade you could see, say, in FY27?
Yeah, hi, Nigel. So one thing is Dixon is not under our coverage, but entering in the component that will first make them a backward integration, and definitely that will add to their profitability from here on. So yeah.
All right. Okay. All right. Let's focus then on the quarter numbers itself. If you had to pick an outlier in terms of a positive surprise, which would that stock be from the coverage universe?
Yes, so wire and cable companies are expected to deliver very strong numbers in terms of the volume as well as improvement in the margin. So Polycab is one of the company which expected a top line growth of around 18.5%, which is a mix of domestic wire expected around 20% growth in their revenue, led by the largely volume. And similarly, that the KEI also expected around 17% of a growth on the overall basis, their wire and cable also expected around 20% of a growth. So these are the wire companies, wire and cable companies are expected to outperform in the spike, whereas RR, which is more on the wire-based company, expectation for the growth is around 15% for their wire and cable. Overall, they are expecting around a 12% of a growth in their top line for this quarter. Even there is an improvement in the margin profile because the copper prices, if I look at, has been quite a firm for this quarter versus the last year first quarter. So that is the reason there is a good improvement in the margin, and we are expecting the profitability for RR to improve by around 32-33%. And so as for the Polycab and KEI is on the little lower side because the margin expected to be maintained on the YOY side of 10.3, 10.4%.
But broadly, the wires and cables will have a good quarter. But they're also expensive. So between KEI, RR Cable and Polycab, which stock offers the best risk reward at this point?
Yeah, you are right. They are now run up quite significantly post correction due to a news of a new entrant. If I look at Polycab, it's trading at 36 times FY27 earning, 35 times for KEI, considering KEI 23% of earnings CAGR and 18% CAGR in the Polycab. My prefer here is a KEI because a KEI is a more on the HT or the LT cable based businesses, as well as extra high voltage segment to kick in from 27 for a KEI. And that will be a higher margin and also will drive the top line for them. So I think KEI is a better placed at this point, trading at a 35 times, and our target multiple is around 40. So there is some good upside in the KEI. Versus other two, whereas RR is trading at around 30 times, and I believe the maximum 32, 33 times is a peak for the RR, looking at the volatility in the business.
Voltas, which operates in the room air conditioning market. Now we know that Q1 was a tough quarter on the back of this unseasonal rains, but that's well documented. The stock, in fact, is down 22% from the start of the year. Is this a good buying opportunity? Do you see the cycle turning and things improving, from a demand point of view? Not backward looking in Q1, but just looking ahead for Voltas.
Yeah, sure. So for Voltas for the RAC segment, there is one event lined up for the 1st Jan 2026. That's a BE norm change, and that will further increase the cost by 800 to 1,000 rupees. Now the summer has been very bad. Now there is a pressure on the brands to liquidate their old inventories as well. Usually Q3 is a quarter where the most of the inventory filling started for the summer, next summer. So I think Q3 definitely they will bring the volume, but the margin may be at a pressure because of a liquidation, because the offers and discounts they need to give. Because in the past quarters we had not seen even a tough quarter. There is no much discounts or scheme were there. So I think the margin is under pressure, will be pressure the way forward. And further, if all things is eyeing on the next summer, if that will be not so great in terms of the prediction, then there would be a pressure on the margin further of increased cost, how they are passed on. So I think we need to wait for a Voltas for the next 2 quarters at least, especially looking at the scenario in the industry. Also, I can highlight over Voltas that their project business to somewhere is quite volatile because of international projects. There are some hiccups they are facing in. So I believe I think we need to wait for 2 quarters, and then after we'll look at the Voltas.
Thank you very much for joining in. Get into a break. On the other side, Manisha will join in to talk about commodities. Stay tuned. Welcome back. Things are quiet, at least on the index front. The Nifty and the Sensex down just a bit, 0.2% lower. Mid-caps flat in the green for now. Manisha is now joining in, and she's got her eye on copper. Manisha.
Well, thank you for that. Yes, that is because most of the metals are not trading in the positive, but copper is, and LME markets really have seen some support come back as well. That is because you're looking at better than expected Chinese data. The GDP numbers, the services numbers were on the stronger side, and various economic data reports show that the improvement in demand is sustaining, whether it's about US or China or Asia for that matter. The market's also clearly reacting to the US levying 50% of tariffs on copper from 1st of August, and the inventories ahead of this tariff has striped up to nearly 7-month highs. A lot of metal from various parts of the world has been flown into US ahead of this deadline of 1st of August. The lack of official details on whether it's going to be about just copper or copper products or copper cathodes, that clarity is something that the markets are still awaiting. So ahead of that, you've seen copper in all forms being imported into US. Well, apart from that, the premium between the US and LME, well, that continues to hold at a record 25%. And the markets do believe that this will only start to ease after 1st of August, once you have more clarity on the products and, of course, the kind of inventories that US seems to be holding. And that is the reason you're looking at such a huge price disparity that we have seen on LME and in US. When you look at the last 1 month, well, LME has seen a 2.5% decline in case of copper because there are no more takers. Whatever copper had to be sent to US already has been done. So now the copper just continues to lie around. And we've also seen the LME inventories gain up. The COMEX copper prices in the meanwhile in the last 1 month have gained up by 15%. And that exactly mirrors or calculates onto the YTD so far. While the LME copper is just about gained 10%, the US copper prices are up by 38% at this point in time. Well, US does import nearly 50% of its refined copper requirement. Much of that comes in from Chile, Canada, and even as China exported copper worth $866 million to US in 2024, the markets do believe that a lot of other trading partners with US are not in a very beneficiary state, and China perhaps could be sending more copper to US. Canada, Chile, copper just about has turned expensive, and this could really change on how copper is going to be traded globally after 1st of August. If you look at supply disruptions, that's yet another thing that the markets are really taking in support from. Remember, copper is essential to modern industry like EVs, infra, and defense as a sector. There is supply disruption that has been reported from Congo, Peru, Chile. Chile is looking at drought concerns, by the way. So supply disruptions, strong demand, and of course, the tariff concerns, all of those factors are keeping the copper prices on the higher side. What is going to be even more important is the whole host of data that is coming in from US. You have jobless claims, retail sales coming in, also the home sales, builders' confidence data, all of that comes in today. And then apart from that, there are 4 Fed officials also slated to give out speeches. Markets will be taking further cues from all of these.
Okay, all right. Manisha, thank you very much for that. State Bank of India is in focus. Sources tell CNBC-TV18 that SBI is likely to launch its 25,000 crore QIP as early as today. Vivek is here with details. Vivek, morning.
Well, that's right. In line with the story, our colleague Ritu had put out, towards the end of last month, what we understand from our sources that SBI is all set to launch its mega QIP. Remember, the company is looking to raise close to 25,000 crore via the QIP route. And we understand that this QIP may be launched as early as later today. Remember, we've reached out to both SBI, and we also reached out to LIC. We understand that LIC is going to be one of the primary participants, one of the anchor participants in this large QIP. We understand that there has been a soft commitment from LIC to put in to put in bids for as high as a little over 5,000 crore rupees for this particular QIP. We also understand that demand from both the mutual fund industry, especially domestic mutual funds, has been very, very strong. SBI is likely to offer a very minor discount to this particular QIP. We understand there's probably going to be a discount of just 2 to 3% to the current market price for this particular QIP, keeping in mind that the demand has been quite strong. We reached out to both SBI, we reached out to LIC as well. Once we get a response from both the bank as well as LIC, we will update our viewers on the same. Just to give a quick update as to what exactly our colleague Ritu had reported earlier. Remember, Ritu had told us that there were 5 bankers that were appointed for this particular QIP, and the main reason for the QIP is to go ahead and augment the capital base of the company. Remember, if SBI goes ahead and successfully completes the fundraise, it will be the first share sales of the bank since 2017.
Okay, all right. Thank you very much, Vivek, for that. Markets, of course, are down about, 60 points or so. So it's a little slightly muted kind of day, 24,140. Network 18, the stock is rallying 11% in trade post its first quarter numbers. The margins have improved for the company on a year-on-year basis, while its share in viewership has risen too in this particular quarter. Let's listen in to what the company's managing director, Rahul Joshi, had to say on the performance and, of course, the road ahead for the business going forward. Just a quick disclaimer, CNBC-TV18, the channel you're watching, is very much part of the Network 18 group. Listen in.
If you look at the last 2 quarters, they have been incredibly tough for the media industry. The operating business environment has been soft. Clients are not spending as they used to. That earnings have been under pressure. I don't need to tell you all of that. In this environment, we have managed to post a 5% dip in revenues. That has to be seen in the context that in the first quarter of last year, it was an exceptional quarter because of election results. It was a bumper quarter for us. So if you were to compare it from the quarter before that, we have grown a healthy 9%. But from last year, it is a dip of 5%. But at the same time, we have kept a tight, very sharp eye on costs. We've been able to control costs considerably. So that is what has reflected in this somewhat improved margins. So I'm very happy with the operating team's performance this quarter. I think it was a tough quarter in which they really came out tops. I think that, in this first quarter, we are EBITDA positive. If you look at the next 3 quarters, I'm hoping that, the overall outlook will improve as we head towards the festive season. I am hopeful that since our channels and our digital properties are all in commanding leadership positions, we will be able to not only drive revenue, but we will keep costs under control in our existing businesses. Costs are mildly likely to go up only in our new investments, maybe in areas like First Post or in money control. So overall, I am hopeful that the next 3 quarters would be better. We are seeing some green shoots, but early days, I would say. July is looking slightly better. I wouldn't be very excited yet. But I think as we hit the festive season, I think we will see some impact on higher revenues. And you have to see it in the perspective that we are the #1 media company, broadcaster, news broadcaster and digital media company. We have a commanding position in the market. All our channels are #1 by a wide margin. We've only increased the gap with our #2 player, whether it is our news channels or it is our digital property. So much so that News 18, for instance, has beaten the Times of India, in the recent ComScore numbers. So that gives us a lot of reason to cheer, and that gives us also a lot of hope for the future.
That's good. Almost doing the same.
Can I start? Bank of Maharashtra has once again posted a pleasing set of numbers with a 23% growth in profits. Advances have grown 17%, deposits by 14%. Both are above industry levels. NIM's net interest margins are down, of course, with all the rate cuts, but they're down only by 6 basis points. The point I'm trying to make is this is one of those rare public sector banks with a 1.8% return on assets, ROA. And a 23% ROE, I think 23% would be the highest among all banks, and 1.8 ROA is definitely the highest among public sector banks. On that note, let me welcome Nidhu Saxena, the Managing Director and CEO of Bank of Maharashtra, to our studio. Thank you very much, Mr. Saxena, for coming over to our studio itself. This conversation is always better.
Thank you for having me, ma'am.
Okay, let me start with the profits. The 23% rise in profit. You've been posting almost a CAGR of over 20%. Now, one small advantage you had was the tax write-back. This year, you told me last time the tax write-back will be over. So, will you still be able to post, another 25%? You've done almost 1,600 crore. So, can you give us a profit of 6,000 crore this year?
Right. So, you're right. We have accumulated losses which are remaining to be adjusted, which are available for this FY 25-26 of around 1,200 crores. So, we were aware of this, mindful of this. So, 1,200 crores I will be apportioning in 4 quarters mathematically equally. But what is not going to change, I don't see much headwinds here. I should be able to achieve my guidance and achieve the profit numbers that we are looking for. Basis which I am telling this, we have been doing extra provisioning. So we are mindful what RBI for some time, regulator tells that these are the best times, good times. Keep yourself extra cushioned, keep making extra provisionings and make yourself better for that if the cycle tomorrow has to reverse. So if you ask me, every quarter more than what IRAC norms are there, we are doing some extra provisioning, quarter on quarter basis. That provisioning will be now shifted to making extra provisions for my taxes. So by and large, that is, so this is one. Secondly, we are also growing fast. And when my growth is happening top line, growth is, mantra is very clear, growth with profitability. Yes. So we are very, very conscious about bottom line's growth. And I think put together these two things, we should be able to manage, and what we plan, we should be able to do also.
Okay. Now let me come to the more crucial question of margins, which we will ask all the bankers. You have lost only 6 basis points. What is the see, at that time only one rate cut had come. Now with the June rate cuts, you have got another double dose. So what can be the impact on margins?
So we have done our calculations with 100 bips of rate cut in stages that have come. It impacts my NIM to around 19 to 20 bips.
Okay.
If you see my cost of funds and cost of deposits in this period has come down by 15 bips. And very, very consciously, we are trying to see NIM contraction is bound to be there. And to what extent we can arrest that NIM contraction. Okay. So 15 bips versus 20 bips, there's a 5 bips. And if you see my quarter 4 NIM was 4.01.
Yes.
I have done 3.95. So it manages.
Okay.
And how we have done the cost of deposits is that we have focused more on the low cost component of the liability side. And very strategically, we have shunned the high cost bulk deposits and replaced them with alternate sources of refinance and raising infra bonds. Trying to see, and that is actually helping me protect my NIM.
So what may you end the year with in terms of NIMs? So there will be a cut in the coming quarter as well. I mean, that is in the current second quarter. but then in the third and fourth quarter, you're getting a little bit of CRR advantage.
Right.
So you may end the year with what kind of margins, exit margins?
Right. So, yes, you rightly said the retail inflation number has come.
Yeah.
Even we have looked at the governor's statement, and there is a scope for a rate cut. And we are okay with the more rate cuts as they are coming. I have a 40% portfolio which is linked to the repo. So it has to be mandatorily passed to that. We will do that. CRR, my around 12,000 crores of funds are blocked for meeting the CRR of at 4%.
Yeah.
Now with 3, I am going to get 3,000 crores freed. I will earn something on that 3,000 crore. That is one thing which will some way offset the part of it. Then in the last 10 to 12 months, we had also done some MCLR review, and 35 bips of MCLR was actually raised. There is some portfolio which is yet to be repriced. I have 55% portfolio linked to MCLR.
Okay.
And we will see another 1 or 2 more quarters where repricing will be happening. So put all together, I am keeping a guidance of 3.75, which is a conservative guidance. This number also I had kept for last year. Despite doing 3.97, 3.98, 3.98 and closing the year with 4 NIM, my guidance last year was 3.75. I'm maintaining that conservative guidance.
But you're likely to overshoot.
So that's what we always want to wish to give the comfort to the investors that MD says, and we are able to deliver. Bank delivers what guidance number is there. So we want to be conservative. 3.75 is the.
What about advances? Will you be able to, this 14%, 17% growth in advances is, very good compared to the system, almost double. System was running at 9% last quarter. Now it has risen to 10. Where will be the growth triggers? Will it be retail? You have not done much on MSME. Will that be, what will be your growth horse?
Right. So we are looking at all the verticals, and I am trying to look at wherever the profitable growth opportunities are there for us, we will definitely participate, whether it be corporate, MSME, agriculture. So RAM plus corporate, I have kept a guidance of doing 60-40, but that number is not something sacrosanct as we see more opportunities. So in the corporate book, we are bullish in sectors where there is a lot of emphasis coming from government. So in the infra, and we are also examining what the risks are there. We are comfortable with road projects under HAM model which are coming from NHI. We are bullish on LRDs. In my last 12 months, we have done a lot of green finance. So renewable energy is one area where we are very bullish on. Data centers we are doing. So all these kind in the corporate sectors, side we are doing. RAM is also doing fantastic. Agriculture and MSME, these two verticals, I have created 2 verticals this year to have a complete focus, and we have done, then the third element is some co-lending interesting partnerships. I have ramped up the co-lending partnerships from 2 when we began the year to 9 now, and it is becoming a substantial book. We are using some in-house technology that is there to take care of the transactions.
Fair points. Actually, I'm out of time, and I wanted to ask you about the way in which you have been able to get the Supreme Court of India account and other accounts, but that longer discussion for another day. Thank you very much indeed for joining us with your thoughts.
Thank you so much for having me.
Okay, so that's the word coming in from Bank of Maharashtra. Excellent set of numbers. And I think an OFS will also come because they are 79%, but that conversation another day. Wrap up on Bazaar. Chartbusters coming up.